Okay, good morning, everybody. Welcome, everyone, and nice to see everyone in the room. And great today, yesterday. Thoroughly enjoyed it. We had lots of good energy and a nice trade. So we're going to start then. Now, in fact, where we left off yesterday in the presentation was the upthrust. And, sometimes things just happen to go exactly the way you want them to. So I actually managed to trade yesterday the upthrust. All right. Now, this was the bar that we took the trade on, as you can. Sorry, it wasn't here. It was actually over here. Where was it? I think it was that bar there. But anyway, what happened? This is the key to it. We've got a couple of very interesting scenarios. In fact, there it was. That was where I took it, right there. Okay, so that was yesterday's trade that I took. Now, when we took that, just as we were finishing the seminar, and lo and behold, the market began to fall, as we can see. But it then came down to what was clearly support. And look what happened. We get 3 green indicators. Now, I can see that the volume on this last one was actually pretty high. It was the highest that we'd seen for most of the session. Closed in the middle, and the next bar pushed up. And that was actually where I closed my position out of the trade. Now, we had a beautiful example yesterday and overnight of where upthrusts appear at resistance, and it's such a good example. I want to show it to you. But it all started actually with that bar there. Now we notice the volume on that bar is absolutely enormous. But why is it important? Look to the left, and just here we have the gotcha bar, this widespread down bar on an increase in volume, closing on the low, and that's taken out all the prior support. Now, strong markets do not behave that way. Only weak markets do. So already I know they're taking out and marking the price down like that. That is where a sign of strength, as designated by the software, actually can become a sign of weakness, because it's taken out all that support. But we need confirmation, as always. So what does the market do? Well, every time it goes up to that bar, the bottom of the gotcha bar, we even get a signal on here. Look, an upthrust. It goes, pushes up, rejects price, pushes up again, rejects it, rejects it, rejects it. So what is the chances that it's going to be rejected again and again? Chances are much higher. These are higher probability trades. Now here we get the highest volume of the session, and we notice here we've got, this happened when we were all watching this chart yesterday. This was some sort of news-driven event, but we noticed there that this starts to make sense to us. We've got weakness on this bar. We've got the gotcha bar in the background, and the market is shot up on massive volume, only to close in the lower 50% area. But it's confirmed because the very next bar closes lower. So what happened? Well, we were obviously using our PowerPoint slide. And actually, Fiona, you're right. There was lots of effort, but no result. So there's a lot of effort there in that volume, no follow through to the upside. So now I've got weakness in the background, right there. Yesterday, weakness, not strength. And what happens? The market begins to fall. Now we've got to be patient. Do we get any signals on the 15-minute chart? No, not until there. And that's the trade you saw me take. And I actually carried that trade for about 4 hours. Now, the reason I chose not to carry it overnight was I did get a lot of volume coming in at the end of the session here, and the next bar closed healthily. That probably meant this was going to pop, and I was actually right. And I told Tom that I was going to take my profit, $480 profit, and then we were going to wait to see if I was right when I said yesterday that the Aussie dollar was still weak, and we would see a 1.0200, which was going to be my secondary target. My initial target was along that line anyway. But instead of leaving the position open, I decided to take some profit, because we were, as you can see, getting into congestion here. All the diamonds began to start to turn white and green, and we began to change behavior. And I wanted to take some profit from the market. I don't try and be greedy. I know there will be another opportunity. And lo and behold, we come back up to this level overnight. We get a signal here, but I didn't trade that, okay, because I know that when I see an upthrust, there could easily be a secondary upthrust. But anybody could tell me why I didn't take the short on that bar? Anyone can tell me why? Just type it in. I'll give you a clue. Look at the next bar as well. So look at the next bar to it. All right, so have a look very closely. Let's put 100 bars up here. So here it is. Look what happens to the next bar. Okay, what happens to it? Does it close higher or lower? It closes higher. So the signal here isn't a confirmed signal. Because if it had closed lower, I would have then looked for a no demand bar. But because I've got this old spike to the left, it's very likely that the professional money will use the top of that bar to trap people. And lo and behold, can anyone tell me what that is? There's no signal on it, but it is definitely there. Anyone tell me what that is? That bar that I'm highlighting here right now. Right there. Come on, type in. We should all be able to look at that bar. Look at the volume on it. It's quite high. Not massive, but it's in the right place because you've got weakness here, and the next bar does close lower. It's a hidden upthrust. Well done. It's hidden. What does that mean? It's closed in the body of the bar behind it. All right. Now, the bar behind it, can anybody tell me what that is? It doesn't have to have a signal on it. Look at the volume, less than the previous two bars, narrow spread. At the top, what do we call that? Well done. Yeah. Oh, these are all VSA experts in here, Tom. Good. They're all typed in no demand at market top, followed by a hidden upthrust. Not a bad setup at all. And it all makes sense. Now, unfortunately, I didn't take that trade because I was not here. But, I was out and about. But it was definitely there. Now, we could have a potential setup to the long side. And that's what Tom's looking for because we've got stopping volume down here. And if we look at the volume on this bar that caused this down wave, we've now got an almost equal amount of volume on the downside. Now, if we see a test along this line, it's very likely going to pop up and we'll spring. And we'll see if we can get a long trade in and spring away from this area. So the upthrust. Now, let's bring Tom in. On the Aussie dollar chart, obviously you saw me take that short and then close it. A good trade, profitable trade. Everything's set up for me there. You have weakness in the background. Then there's an upthrust. But overnight, the market's gone back up to that same level and they've upthrusted it again. Now, is that common? Because a lot of people who were short or would be short suddenly see the market going back up and they go, oh my goodness, what should I do? So my decision was instead of swing trading that and holding the position, I closed for profit, waiting to get in again, which I think was a good decision. So talk to us about hidden upthrusts, and when's the best place to short them. Here's Tom.
Yeah, thanks, Gav. Well, the thing is that if you're short the market, I would say it's almost will happen that on one of those down bars, you'll see some stopping volume. And if you're short the market, and as soon as you see stopping volume, you need to get out or certainly get out of a short position. Because if you look at all these bits of markets, whether the pound or the S&P, if you've seen an upthrust and if you've shorted it, right, you're very happy with yourself, the market's falling. However, you will get automatic rebounds, as they say. But the thing is that if you watch the volume, you'll see stopping volume coming in or came in on one bar. And then that's a warning to you that they may have a move up. So you won't get a move up unless you see something at the bottom that's going to cause that. You have to have a cause, a reason for it to go up. Professional money needs to enter the market in some degree, anticipating a rebound. It's almost like a ball. You know, you drop a tennis ball, it'll fall, yes, but then it rebounds. And the market tends to do that as well. But don't worry, you'll soon see it all, because you put all this effort into it, and it'll come round. It's not easy at first because it would appear illogical, the market, to somebody that hasn't been shown the real truth in these markets. And it just doesn't make sense to a lot of people. That's why I've rarely talked to people out there that don't know about the market, and they just think you're talking a load of rubbish, most of them, because they don't understand it. They say, well, if that was so, they would be telling us on TV and all the rest of it. So I don't bother to speak to many people out there, only on VSA circles like this.
Is there a setup on this chart right now?
Well, I'm looking at the 5-minute Aussie dollar, and there was definitely some stopping volume right there on the low. Can you see that, Gav?
Climactic action, number 136.
Yeah, there's definitely some stopping volume there, and that's why it's gone up a few bars. However, of course, we are always looking for that ultimate position to go in. And what we'd like to see is a test now, or a down bar where the volume is very, very low. And, of course, it'd be lovely if it went back down to that same level where we first saw that climactic action there to the left on the low. And if the volume was really, really low, especially if the computer colored it pink, then that would be a sign that it's going to go up, pop up. And it'll go up until some additional weakness appears. Right? It's not accumulation to go to the moon. It means it wants to automatically, an automatic rally, they used to call them. It's just the way it is, the way balance of supply works. And but watch out for that.
Can the market still push down further? Because it's in a downtrend, someone said.
No, I doubt it. Not with stopping volume in the background. I doubt it very much. Very much.
Would you want to go long here now? Or would you
what I'd like to do would be wait for the market to fall. Now, if it may not do it. The market's devious, it's cunning. It won't always do what you want it to do, unfortunately. That's one of the problems of trading, I suppose. What I'd like to see, the market now fall slowly back down to that level where we saw the climactic action to the left there. And you see the volume is low, the volume's colored pink, then you go long. And then you just follow the trading system, the simple trading system, and try to milk as much as you can out of the move up.
So a question came in, is this counter trend trading that you're doing? Because the trend is definitely down on every time frame. So are you counter trending if you go long?
No, I'm trading a temporarily pop up in a general down move, which you will get. The market does that because don't forget, you have to have more losers and winners for these markets to work. And the only way that can happen is the market moves up and down and does exactly what you don't expect it to do or want it to do. But that's how it works, I'm afraid. But this trading system's fine if you happen to be a fund manager and you're looking for results over the next year or two. But I personally, well, I could do that if I was a fund manager, but I'm not. But I like to just buy when I see a setup appear, take a few points, right, then go and have my cup of tea.
Now, the question is, at the moment, it's come down to the closing price down here. Is it the close or the bottom of the bar that you want it to come down to?
Well, back into that area, the body of the bar.
Which it's in now.
No, it's not. Look, there's the low.
Right.
It's here, isn't it?
Yeah, and there's the high, so it's in the body now.
No. Here, look, the body of this, where the volume was.
Okay, yeah, it's not quite down to the bottom of it. Okay, so you're looking at the close and the lower section.
Yeah, it needs to go back down into that area on the down bar. So it'll be a red bar as far as I'm concerned. And if you see the volume very low, now if the market does it, it may not do that. If the market is still weak, then it may fall. But it won't fall if these principles are followed. You've seen definitely stopping volume.
Yep.
Now, that's you would expect what they call an automatic rally. In other words, a rally from the down effect. But we'll watch it.
All right, so we'll keep an eye on this chart on the other screen here, and we're looking to see if the principles here hold. Now, we've definitely got some stopping volume. What I like to see, and the way I trade these things, is I wait. Now, you could go long as soon as the market tests this area, and go long at around 26 and look for the push up. But the safest trade, if you want to be safe, and there's no such thing as totally safe, is to actually wait for these diamonds to start to change. But the problem with that is you're going to miss quite a lot of the bottom move here. So what we're looking for is the market to come back down. Let me be very clear what Tom said. Back into the body of this bar, which is the low and the close, or they could even test the closing price, which is what they're doing now. And if it comes down in here, and as the market falls and retraces, after this climactic volume, you get very light volume on the falling price. That would indicate that a pop-up is coming. Now, how often do we see that? Very often. But there are times, if the market's very weak, that this will just continue. So remember, it's all about risk-reward. Do I want to take a trade in here now, and if I'm right, get a very nice piece of the pop, or do I want to wait for a change in behavior because it's still trending down, and then trade a test in a rising market? Now, I have three ways of grading my trades, grade 1, 2, and 3. If I put 3 contracts on, that means the probability of my trade is extremely high, and I rarely lose money on those trades. A level 2 is what I call a considerably more risky trade, but ones that I'm comfortable with, like no demand in a downtrend. And level 1 would be something like this, where I'm trading against the trend of price for the day. We have had a big down move behind us, but now we've seen clear climactic action coming in here, and I know I can put a pretty tight stop in a few ticks below here and reduce my risk. So I'm going to see now what Tom is saying is happening live. The market is retracing into that area on reducing volume. And I've seen Tom take these trades many times against the trend and make a lot of money on the way up. So please note that these things do work, and it's a good system, a good setup, because it will often mark the bottom of that trend for the time being. Now, the question came in about time frames. Which time frames did I use yesterday to manage my trade? I used the 5 and the 15-minute chart. That was all I needed to do to know when to get out the position. So just the 5 and the 15 was suffice for me, because I'd already made a decision I wasn't going to carry the position overnight. I wasn't going to carry it through the Globex, so I didn't do that. What would be a level 1 trade? Well, a level 3 trades would be end of a rising market or bag holding, Ken, followed by no demand or an upthrust. If I'm shorting, the really good probability trade is end of a rising market. The market falls. It either goes back up to that same level and there's no demand at that same level where the end of a rising market was, or you get the upthrust. Either of those confirm the end of a rising market, and then as the market begins to fall, I trade the first no demand bar that I see, which is an up bar. That is a level 3. Okay, Lance is here, and he's got his microphone. Remember, if you've got your microphone, we can open it. So if you want to talk to us, don't be shy. Yeah, hello, Lance. Morning to you.
Yeah, afternoon.
Yeah, it's it, isn't it? I can't tell you. Since I got back from Australia, I've lost all sense of time and wherever I am. Anyway, you had a question, mate, and Tom's here. He says hello to you.
Hey up, Tom.
Hey up, Tom, he says. Hey up, Tom. So what's the question?
Right, when we come down to the low and the close of the price on low volume, following the stopping volume to get the pop-up. Now, the volume, obviously, there may be 3 bars down there, and they're different size volumes.
Yep, here.
So the low volume, are you looking for 1 bar with the low volume, or do you take into consideration maybe the last 4 or 5 bars?
No, I take into it, you don't know how many bars, you don't know how long they're going to test that level for. This could go on for the next 20 minutes. We don't know. What I do know is as soon as the price goes above the top of that bar again, I'd probably go long with one contract, personally, looking to catch the pop, because I could put a tight stop in. So I could, see, what Tom is saying has happened, isn't it? As we, look, there's the bar,
Okay.
right? And
Can you
there's,
go back to that bar there, Gav?
yep, that one there.
The pest light bar. No.
Yeah,
Four more back.
I would have been told it was
One more.
exactly what I said to you.
That bar. Right. Okay. That's on low volume.
Mhm.
The next bar, sorry, is up.
Yeah,
But it's on higher volume.
let me just clarify that. That is not a low volume bar. That's not
That's
low.
not low.
No, look at
Because it's
look,
the
look.
average line.
Yeah, and look what the software tells us about that bar. What does the software tell us?
It's high. Yeah.
It's still high there. It's still now. They've tested it again live. Okay, so now you've got a test, which is exactly what Tom was looking for. So you've
Right,
now,
yeah.
but the test is on high volume, but that's not a bad test. I mean, that could very easily pop up right now because it's closed. The market's been marked down. The volume's fairly high here, but it's closed on the high of the bar. I think what Tom is suggesting is going to happen. I think they'll come and bring it down into here, into this area, and then you're looking for volume like that or like that. Really low volume. This might take off.
I actually would have thought, looking at that, if I was trading, I must admit, I'd have just seen that as low volume.
Yeah,
And
no,
it's
look at the yeah. See, you've always got to see when you look at it in comparison to that. Of course, it looks low, but you've got to look at it in comparison to all the other volume bars around it. It's like human beings. Okay, so I'm 6'2", right? So there's Gavin, all right, 6'2". There's Yao Ming, he's definitely there, and that is still a pretty tall person. But compared to say this bar here, that's low volume, and the software tells us it's low, and it's down into that area that we were looking for. And the next bar has responded in a positive manner. So this is very likely to pop up. Very likely. But we'll wait. You've got to be patient. Terry just asked me, what is the Globex session? It's the session that runs overnight, Terry. It's outside the normal market hours in the US. Most futures contracts run what they call Globex, which is they're running overnight. The S&P, for instance, the E-mini S&P trades during the day, but it also trades overnight, and that's called the Globex session, for those that didn't know. All right, well done, Lance. Good question. Anything else, or are you okay?
No, I'm just, you know, that volume there is so much lower than the previous 4 volume bars, isn't it?
It is, but it's still high in comparison to other bars around it here. When I say low volume, look, let's hope that we'll see it, and then when you see it, we can go and have a look at it. All right, so let's see if we get the low volume. All right, I'm going to just mute Lance for a second there. Now, let's. By the way, Lance, several people said, "Great question, great question." Someone says, "Why didn't I place an order in here to go long now?" I will be looking if there's an opportunity here. I'm still trending down. I'm looking to see if they're going to mark this down a little further. But it looks like what Tom is telling us is happening now. This is one of Tom's setups to go long. So we'll come back and we'll look at it. All right, so let's finish our thoughts on the upthrust bar, because that's where we made money yesterday, or at least I did. And it's one of my favourite setups. Gling's asking, what stop range do you normally use if you carry your trade overnight on the futures? That's a very good question. If I'm trading, it varies, Gling, for every market. So I can explain to you, on the Aussie dollar, I use a 27 tick stop for trading overnight. And I use a 13 tick stop for scalping, for going in and out the market quickly. That's for the Australian dollar. It's slightly different for the S&P. For the E-mini S&P, I'm using a 13 tick stop. Okay, so that's 13 ticks away from the market. And that's during intraday trading. And if I carry a position, I'm using a 19 tick stop. That's just over 4.5 points. So I hope that answers your question. And they're different. And on Friday, we'll look at all the different markets, and I'll give you the different stops that you can look for. But can I just say, stop loss placement is very individual. I would not like to tell you where to put your stops. That's not what I'm here to do. We're here, Tom and I are here to teach you principles. How you manage your positions and how you trade is down to you as an individual. Everyone's different. There's no right or wrong. And let me explain why. You know, if I'm trading a £100,000 account, I can easily carry, if I'm only trading a few contracts, I can have a bigger stop. But some of you out there will be trading a $5,000 account, and you won't be able to carry that size. So just remember that. Everyone is very individual. Okay, whoops. Oh, I don't know what happened there. Let's go back. Right. Okay, so the upthrust. Okay, so upthrusts, in my opinion, work best in two places, and I'll ask Tom to give me his opinion as well. They work best when there's a market or a clear resistance level to the left, or they work extremely well when the market is in a downtrend. That's where they work best. Do you see upthrusts as the market's going up? You see bars that look like them, but they're not genuine. I'm going to ask Tom to explain that. So Tom, one of the biggest confusions for people with VSA is they look at an individual bar, and there was a lady in Malaysia, I called her Miss Upthrust because she just couldn't get this. She said, well, look, an upthrust is this. It's high volume. It does that. Looks like a telegraph pole. I said, exactly. That's a great up. She said, here, there's an upthrust. And it was in a big uptrend, and there was a shakeout right behind her. So there was a lot of buying. She sees the upthrust and says, now I short. And I said, no, you don't short that one. It's in the wrong place. It's a polar bear in Hawaii. And she just couldn't get her head around that. So do you want to try and explain to people what we mean by an upthrust in the right place?
Well, you have to think about, you have to more or less think the way the smart money or the people that want to unload in the background would do, right? Now, obviously, they're not going to start having upthrusts if there's a sign of strength right behind them, right? Because sometimes the market will buoyantly go up only to rest, come back down, rest on the low. And it does look like an upthrust, but it's not an upthrust because you've got strength behind you, not weakness. And it's very important now, talk about that scenario where the market goes up with buoyancy, with enthusiasm, only to close on the low, and you've got strength or an up move behind you. Now, one of our strongest buy signals can appear right now, and that is that if after you see what looks like an upthrust, and you may even get a red signal appear on it that tells you it's an upthrust, right? Because the computer's not so clever as you are. The very, very next bar is down, yes, but you note it's down on a narrow spread, close in the middle, and the volume is low. And if you're lucky on that particular time frame you're looking at, you may get a signal on it, right? That's one of the strongest signs of strength we have, because professional money would have seen that, what looked like an upthrust, and they're just wondering what it is. Probably they don't know everything, so they test the market the very next bar, and lo and behold, if it's down, narrow spread, close in the middle, and the volume is low, especially if it's colored pink by the computer, it may or may not come up with a signal. That's the place you can go long, and be rest assured that you will be very unfortunate if you don't make money on that.
Where's your favourite setup after you've seen an upthrust? Do you go straight in on the upthrust, or do you wait?
Now, we're talking about a genuine upthrust.
Yeah.
You see, an upthrust, everything's called an upthrust, but it's only a genuine upthrust if you've got weakness in the background behind you. And then the reason why that is there, because professional money are fully aware the market's weak. They've been holding it up while they distribute. Now, more or less, when they finished that phase of distribution, they say, right, now's the time to get them. We'll mark it up, catch all the stops. Remember, the thousands of stops above and below these actively traded markets will trigger a lot of those stops, panic those traders that are short, encourage people to go long, and believe me, there's no end of the benefits of an upthrust. But it's only a genuine upthrust, so they mark it up, close on the low, right? The volume could be high or it could actually be low, but it's usually a little bit high. But it's only a genuine upthrust if you've got weakness right behind you. It's not genuine if you've got a bull move behind you and shakeouts and signs of strength all in the background. It's not an upthrust. So try to remember that. Don't just go by the pattern of the bar. Looks like a telegraph pole, yes. But don't just do that in mind. Visualize where the upthrust is. Visualize why should you have an upthrust here. They're obviously not going to mark it up to catch stops if they're in a bull move. That would be no benefit to them at all. They'd probably lose money on that deal. So you do get what looks like an upthrust, but not very often. But a genuine upthrust occurs when you've got weakness in the background.
Okay, quite a few questions coming in here. Question from Rob says, sometimes, Gavin, after a bull move has been in place, I don't see end of a rising market, but right at resistance, we get an upthrust on very high volume, and the market then collapses. Okay, so Tom says that is in fact supply overcoming demand, and yes, that is definitely tradable. Definitely tradable. I mean, the best place to trade an upthrust is either in a downtrend or when it's on massive volume at a resistance, clear resistance level, and it closes on the low. Those are the two best ones. If you see an upthrust in an uptrend, especially if you've got some sort of shakeout behind you, it's probably best to just leave them alone. Okay, Lance, I'll open your mic again. You had a question as well, Lance.
Yeah, question for Tom.
Question for Tom. Okay.
Tom, are smart money interested in small cap companies? Are they interested in that? Does it? Yeah.
Okay, Tom, the question from Lance is the smart money, the professional money, do they trade small cap stocks, stocks, little small stocks, or do they really go after the big stuff? Yeah. Hold on, here's Tom.
No, they're not too enthusiastic with small cap stocks, but they will trade anything where they can make some money out of, believe me. Don't forget the markets also rotate. In other words, we have different sectors in the market, which you can see, which are tracked by charts. You may have industrial, farming, chemicals, all that type of thing. And if you look at them, if you're going to pick a stock to trade, obviously you want a stock out of one of the sectors that's showing strength. So that's always a good thing to do. But the professional money are not usually interested in the small cap stuff. But they will trade it if they have an opportunity that they see is going to benefit to them. But normally they trade all the stocks that make up parent indexes, like the Dow Jones and 30 Industrial. They'll definitely be trading all of those. Now, I noticed yesterday Gavin mentioned something about the same stock in different indexes. Well, they will move together. They won't move separately. They will move together because of these arbitrage traders. That's what they're looking for. They love all that. And they've got a mathematical formula which will deal with that, where they buy one, sell the other one instantly, and make a profit from the difference. The only thing we can't do it is that you need a lot of contracts, and it's usually way above our ability to do that. But they will move, because don't forget these arbitrage traders, so they make their living. And not only are they looking at the indexes, they're looking at everything. They can, of course, and they wander around the floors looking. I know, I've seen them. So keep all that. That's worth keeping in mind.
Yeah, fantastic. Thank you.
Okay, now we've got a chart here from Morris, and it's a great one, actually. This is a good example, so thanks for that, Morris. Good question as well. So what we got here, okay, you've got a chart that's got all the signs of distribution at the top. You've definitely got supply hitting the market right here. That's the highest volume that we'd seen apart from this bar here. It's a bit of an unusual bar. I'm not sure I could make a lot of sense of that. But the market continued to go up. When they saw that volume, it was tested over here, look. It came back down. You got some buying here. And then they mark it up. Big markup. And the volume is pretty high, as you can see. Software reads it as ultra high. And then we start the first phase of distribution across this top. So the next bar here goes up on no demand, which after that bar is a bit of a clue something's going on. Then we have some more weakness appearing. We notice that the spreads of the bars are beginning to narrow. Now, after that, when you get narrow spreads, especially on high volume like this, and here, like we've got the upthrust type looking bar, we look for a change in behaviour in the market. And suddenly, we get this bar here. Now, look, it's got a green signal on it, yeah? It tells us potential climactic action. But that is in the wrong place. Because I like to see those bars after a big downtrend has happened. This has happened as the market's trending up and has begun to distribute. So when you see a widespread down like that, if it's taken out the previous 2 weeks support, then we have to look for evidence as to whether that's going to make the trend continue or whether they're going to mark it down. So I wouldn't do anything in here at all. I wouldn't have been trading in here at all. Here, when we get the upthrust, don't we? And it's telling us, what are they upthrusting? Always ask yourself the question, what is being upthrusted here? That's the highest volume in the background. That's the Yao Ming bar. Look at the closing price on that bar and look at where they're upthrusting it to, and now it starts to make sense. Now, the upthrust is on pretty low volume, so you don't see that particularly often, but it does happen. But it tells me, again, effort versus result. If this is a strong market here, we should be pushing up, but the result is a close lower than the previous bar, and the next bar closes down. And with that in the background, and the diamonds have changed to red, you don't want to be thinking about going long at all. If anything, you'd be looking for a short trade there. And in fact, the market does begin to go up here, but look at the volume on the upside. Very weak. And now it's been marked down through any support that was there. That's gone. So any no demand bar here would be a potential to go short. And where they're going to come down to, very likely they're going to come and test this bar here, which was the top of that bar. So it's a good one, Morris. Good example. That upthrust is not, if that was on ultra high volume or massive volume, I would be inclined to short it straight away there. But it wasn't particularly on high volume. But it was a weak bar, definitely. If I was short now, I wouldn't be out of this position if I was short. No, I wouldn't be out of this position at all. There's no stopping volume here. If I'm short now, there's no reason to be out this trade at all. Because, Thomas, the market is behaving weak, and every time it goes up, it's going up on no demand bars. Very low volume, narrow spread up bars. That's behaving weak now, not strong. Okay, good. Good questions. Okay. Now, here's another example there of an upthrust after a gotcha bar. Okay, now, can everyone spot the gotcha bar on this chart? Can anyone tell me where it is? Anyone spot the gotcha bar? This is a weekly futures chart. Anybody spot the gotcha bar? Yep, you got it. There's a few of them. There's one that's very obvious. There's one that's very obvious. Right at the market top, look. Look at that. Now, that is a down bar on high volume and will very often produce a green signal because the computer is seeing a widespread down bar on high volume. But I know that as the market's rising and rising and rising, at some point, the professionals will want to take profit. And this is called the gotcha bar. It takes out the previous 4 weeks of support. So the market's been rising, rising, rising. And you'll usually find on the daily charts, there'll be no demand up here at this top. There'll be no interest in higher prices. Now, what happens now? The market goes sideways for several weeks. And then finally, there is a beautiful upthrust. That's a classic upthrust. The volume is higher than all the background. It closes on the low. The next bar closes lower. And you can short that upthrust because it's now in the right place. The volume's massive. I love ultra high volume up bars like this. Jitendra says, can the software scan for the gotcha bar? Not yet, Jitendra, but it's a good question. We are looking at developing the scanner so it starts to look for specific bars and setups. So yes, it will be able to do it, but not at the moment. But there is a signal called no result from effort, which we're going to talk about, which you can find in the sidebar scanner here. You will be able to see that. Let's just get rid of that chart of gold there. I don't need that. So that will be able to happen, yeah, absolutely, definitely. So what's going on here now? Going back to the Aussie dollar, look, we've come back down into the body of the bar, and this is now trying to spring. It's trying to push away from this level here. Now that top line, where I'm going to put a green line, would be an area where I'd be interested in taking a trade to the long side if the market goes through it and we test it. Because it will now, you could go long on this very next bar because it's going to be a test by the looks of it. And it's trying to accumulate now. This is what we call churning the market. And when we get to signs of strength today, we'll come back and look at this actual live chart. That's the beauty of doing the mentorship course with Tom, because he's scanning all the live charts as we speak. So here we have what we call the no demand upthrust. Okay, they do exist. They're not in the software. We don't have a name for them, but they're there. We can see them. These are very low volume bars at resistance. So where the yellow box is on British land, this is a UK stock, you'll notice very, very high volume on that up bar. Okay, and that is the first phase of distribution. So they always do this in phases. Markets move in phases. At point A, we get a very nice upthrust again. They're upthrusting the actual base of this bar. That's what they're doing. And at point B, that is what we call a genuine upthrust. That's a hidden, and that's and the difference is a hidden upthrust closes within the body of the bar behind it. A standard upthrust, if you want to call them that, closes higher and above the previous top of the previous bar. And if it's on very high volume, these upthrusts are very, very powerful to short on. Yes, it is, Dave. Dave's asking, is the live market scanner to TradeGuide a proprietary tool? Yes, it is, Dave. Yeah, you don't get that in any other software. It's only available in TradeGuide. So at point B, we have a low volume, no demand upthrust. But again, it all comes down to effort versus result. The market is lethargic here. Now, Tom explains the story of the dying man climbing up the hill. Do you want to explain what you mean when the market becomes lethargic and runs out of energy?
Well, that's no demand, isn't it? Yeah. Occasionally, you see, the thing is with studying and being able to read these charts is that no pattern will ever look exactly the same as the others. I can guarantee that. But what you would do as a chart reader and knowing what's going on is you can read as the market unfolds. Now, I remember, this was some years ago, it was the FTSE actually, it had been crawling up. And it had gone up initially, but then it was rounding over, like Gabby was saying, a mushroom shape. And it was crawling up, and it was just going up a little bit every day. And I was actually short, and I kept seeing it going up little by little. But I knew I was fairly right, because the volume was really low, and it looked like a mole man trying to climb up a hill, and he was running out of steam. And of course, eventually it did. The whole thing collapsed. But when you see that, you know that that market is weak. So that's why you get these mushroom shapes. We call it a mushroom because everybody knows what a mushroom looks like. It's a nice smooth dome, and very often you see that. But you may not, you never see the same thing exactly the same. It's like stand back and look at a tree. Right? Say, all the leaves are all green. Right? They all look the same. But when you go up and look at them, every leaf apparently is different on a tree, which is quite surprising when you think about it. Excuse me. No one other leaf looks like that one. And the market goes like that because it's run by human beings who in their very, very nature are unpredictable, due to their emotions and one thing or another going on. But don't forget that some of the professionals, not all the professionals are right all the time, and they get it wrong. I've seen traders on the exchange of these floors. You could almost see the veins standing out their neck because they're on the wrong side of the market. And so some of them get it wrong, but generally speaking, they don't.
Yeah, thanks, Tom. What do you make of the Aussie dollar at the moment?
Well, I'm watching it here. It's tested. It's going down. Hopefully, but it's taken a long time, and sometimes that could be a sign of weakness. Look.
Yeah, well, you've actually got a signal that's come up there, and let's go and have a quick look.
Yeah, it certainly looks like a place to go long. Just like to see it go a little bit lower for perfection.
Yep. So what have we got? We've got Yao Ming just here. Now, I know we're talking about signs of weakness at the moment, but you've got your Yao Ming bar. It's come down here. We've had a first test, effort to rally. Yeah, the high volume came in. They sold a bit more off. Now we've got the very low volume. Lance, this is what we're looking for. Look, that's lower than the average. It's a down bar. Okay, now these trades here, you can go long here with a fairly tight stop below, and if the market falls lower and takes you out, it does so. But here, it looks to me like they're trying to accumulate here at this level and pop this market up. So it'd be very interesting to see. Okay, Nathan said, talking of upthrust, there's a real-time upthrust on the 7-minute chart of the futures. Let's go and have a look at the... yeah, let's have a quick look. Actually, the S&P is doing the same thing. There's strength in the background here, right? Yeah, so be very, very careful here, because this is exactly the same as what the Aussie's doing. This again could potentially be a setup. Now we've got to be careful here. I certainly wouldn't want to be long just yet. I would definitely not be long yet. Not against that overall trend, but we've got the Yao Ming bar in place. And again, very similar now. We're going to want to see if they come down and test this level on low volume. And when we get to signs of strength, which is in part 2, we could have a lot of things to be talking about live. YF's asking, why is not absorption volume? Absorption volume happens in up moves. Okay, so this is more likely to be stopping volume rather than absorption volume. And it's very climactic. There's a lot of, it's in the London session. So some group or groups have stepped into the market there to try and attempt to stop it. But whilst there's a lot of volume, there's supply still present. It means there's sellers present. So professional money are going to want to keep the price down here to test, to see how many sellers are around. And if people are bullish down here, we'll get very low volume as the price falls. And at that point, we'll be able to see if there's a trade to the upside. Okay, so the upthrust then. We short after you see an upthrust, but remember, this can and does appear in an uptrend, but is not a genuine upthrust because you're in an uptrend. It is a far more powerful short in a downtrend. Don't short in an uptrend. It's in the wrong place. And the only time that I would ever short the upthrust when there's an uptrend behind me is when it hits serious resistance to the left and the volume is ultra high. Terry says, do you take a lot of notice of a gap up upthrust, low volume type bar in an uptrend? No, Terry, I don't. No, I don't. I don't. I always look initially when I see an upthrust, do I have, the first question I ask myself is, do I have strength or weakness in the background? Okay, that's the question. Do I have strength or weakness in the background? And if I've got weakness in the background, like the end of a rising market or a buying climax, I'm going to give a lot of weight to the upthrust bar. Okay, my favourite setup, really one of them, there's several to go short, but this is where you're going to make your money. Tom, can you shut the door? I can't hear. Sorry, we've got Tom's gardener outside. He's having his grass cut today. So, sign of weakness number 5 is no demand in a downtrend. Okay. So Lance, no, I'm just trying to understand your question. So when it gets down there and it is not low but average volume, it is likely to collapse further. No, not necessarily. No, we'll come to that chart, Lance, when we talk about strength, because we've got the good thing is we're going to watch the chart unfold in front of us and decide if there's a trade there to take. And if there is, then we'll take it. But let's keep with the PowerPoint for the moment, because I want to finish on the signs of weakness before we take a break here. So no demand in a downtrend. This is really where you find it easy to make money using VSA, because once the market begins to fall, it will go up, obviously, because the market maker holds it up. But if it goes up, and as it's trying to go up, the volume is declining less than the previous 2 bars, we call this no demand. And it works especially well after you've had some sort of sign of weakness, like the buying climax or the end of a rising market. So Tom, no demand, one of the key principles of VSA. Can you explain it?
Well, thanks, Al. No demand is what it tells you. You've detected no demand in your chart, in the market you're following, and no demand means that the smart money is not participating in a markup, an up move. Like yesterday I mentioned the auctioneer in an auction, if he's whatever he's selling, right? They have all these auctions on TV in England here, so I see it often. The guy, say a pot of some sort is worth even £20. The auctioneer looks up, he says, right, £60, £60. Anybody bid £60? Now, the estimated auction price was £20, so they marked it up, so it's artificially marked up. And the market makers can do the same thing. They can mark these markets up if conditions allow them to. But we know it's been marked up because the volume is low. Professional money is the one that alters the volume or the activity you see below. It's their activity that we're looking at, not Gavin's, yours, or mine, or the guy over the road. It's the professional smart money. And when you see that market is marked up, especially if there's weakness in the background, right, and you see the volume is low, especially if the spread is narrow, it can even be gapped up, right? They will do that if they can. They will do everything in their power to catch you, mislead you if possible, because that's their business. They want to make money out of you. But if there's weakness in the background, right, end of a rising market or climactic action or any of those signs of weakness, and you see the market's marked up on a narrow spread, close in the middle usually, and you look at the volume, if it's pink, it's guaranteed to be no demand. That's the place you short. It's very easy to see, not difficult to understand. Just think of the human professional activity in the background.
Yeah, Morris is asking, can no demand close on the high? It very often does close on the high of the bar, Morris, but the key to it is the volume. You might all want to write this down. The volume is less than the previous 2 bars. That's what makes no demand, no demand. And we always need confirmation. And we get confirmation after the no demand bar has closed. The next bar should close lower. Then you know that market's very likely to fall. And no demand works best when you've already seen a big serious spurt of volume, like an ultra high volume up bar, and then the market begins to fall. Now, the best place to make money on these is after you see the ultra high volume up bar, mark the bottom of the bar with a line and project the line out. Now, when the market comes back down through that line, which it will, and then goes back up to the bottom of that line, and there's no demand there, that's where you short it. You'll make a lot of money just on that signal. It's very, very powerful. Let's show you some examples here. Now, here's an example of no demand. You see we've got a high volume up bar, and the market staggers up, as Tom said. It's like the old man climbing the hill. Notice the spreads of the bar are narrow, but the volume is less than the previous 2 bars, and the next bar closes lower, and we're already in a downtrend. You see this happening all the time. If the market staggers up like this, and the volume is getting lower and lower, and the spreads of the bar are getting narrower and narrower, it's like the old man running out of steam. And you know that the market will at some point fall further. So these are great places to go short. Here's another example. Now, this is a stock, a London stock. To your left, you've got clear weak bars. All of the yellow bars here are weak. Okay, we've got no effort here. They've tried to push the market up. It's closed on the low of the bar. Okay. Then you've got weakness here, the up thrust. You've got a weak bar here. That is, in fact, no demand, a no demand up thrust. And then the market falls right down. Lance, you got a question? Shoot away.
Hi. On the stopping volume, we're saying that the volume goes down to we go back down to the bottom of the bar of the close of the price on low volume.
Right.
When it's no demand,
yeah.
Why is it we don't go to the top of that bar on no demand? Why the bottom of the bar?
No, you can go to the top as well. Don't get wrapped up in it has to be the bottom. If it's the bottom of the bar, it's a better probability trade. Think about the logic of that statement. Because if the market's already gone through the bottom of the ultra high volume bar, so the price has already fallen, it must mean supply had to have overcome demand on the ultra high volume bar. So if it now goes back up to the bottom of that bar and the volume is now very low, that is a very good place to short. Now, can you short the market at a no demand bar after you see a spike in volume? The market then goes back up to the top of that bar on low volume. Yes, you can. No problem at all. But you do risk an upthrust. So you can get stopped out on those ones. I tend to find, and again, it's all about probability, Lance. Probability-wise, I've made my most money on shorting as the market's fallen through the low of the ultra-high volume bar and then gone up to the bottom of it on no demand. But the principle does work just as well, although I sometimes find when it goes to the top of the bar, as you're discussing, you can get an upthrust, so you're short, and suddenly you see the market taking off, and you say, well, that can't be right. And then you sit and wait for a few minutes, and you see an upthrust has formed. That happens. But no, to answer your question, you can have no demand at the top of the bar or at the very bottom when it's broken through the bottom of the bar. Both are perfectly good places to short because you've got the weakness in the background. Make sense?
Yeah.
Good stuff. Okay, and a question from Grigory. Okay, so you're a bit confused. Sometimes you're saying that the stop lot or your order, okay, so your order has to be put under the no demand bar, but you still need confirmation. Will you put the stop order then on the bottom of the second bar confirming no demand? That's a great question. When I see a no demand bar, I have two choices that I can make, okay? You can sell at market, so you can just see no demand and not wait for the confirmation bar because you've seen weakness in the background, or you can wait for the next bar to close and then go in at that bar after the no demand bar. The safer place to go in after you see no demand is when the next bar is closed lower than the no demand bar. Some traders that I've taught see no demand bars and place a sell order one tick below the bottom of the no demand bar. So as the market falls, it takes them into the trade. However, there are times when you'll be taken short on that strategy only to see the next bar that you've been taken in the market close higher than the no demand bar. It happened to me last week. But fortunately for me, the market was weak and it fell further. So that's down to your individual style of trading. If you want to be safe, here's an example. There's no demand. There's your confirmation. As soon as that bar closes, you can go short because you've confirmed no demand. You've got weakness in the background. You're in a downtrend. And you'll notice here and here where your ultra high volume bar is. Here's your ultra high volume weak bar. Note the price falls through it here and here. See these two bars? And now we go back up to that level on no demand. That's a great short. That's a great short. Morris is saying on Google, okay, I need to go and look at the chart. Okay, let's go and have a quick look. Well, this is the day that they released their earnings a little bit early. So it says we had an upthrust on October the 11th. Yes, we did. Yeah, that was prior to this news announcement. It wasn't very high volume, but it did upthrust. This is what we call secondary upthrusts, Morris. And it does alert us that they're trying to get people to buy there when in fact they're selling. So the real upthrust, the real good one is there, look, on 25th of September. Now, the market doesn't immediately respond negatively. So they do a secondary gap up upthrust here. And then we get this massive bar that takes out all the support. Now, the question we've got to ask ourselves, is this buying or selling in here? Is this likely to be a 50% retracement to buy more? Well, they're testing it right now. And the question you had, how do you handle temporary strength if you're short? Well, if you're short this now, if this is going to be further weakness, you wait to see if this goes up on no demand. Because if it goes up on no demand, these diamonds will stay red, then you could stay short. But when you see wide spreads down like that, there is weakness in there, but you have to ask yourself, is this an opportunity for some buying to take place at lower prices? I'd be a little bit patient here, but that is a weak bar. And that happened on news, so we know that the news actually marked that down. So going back to no demand, I'll repeat what I said. This is the great setup that I'm showing you now. There's your weakness. There's the low of the bar. The market penetrates the low of this bar. There, and 2 bars it does it. It then staggers sideways. It goes down further. So we know there has to be selling there. And now the market maker marks the price up, but there's no interest in higher prices from the professional money. And bar B confirms it, and that's a great short trade. So it's no demand back up to the closing price. Yep. Or the closing price is relevant. Or if we look at the bar here, Lance, look at this bar here. Look at the volume. That's the high volume bar. That's where the market penetrated it, as we can see. And it's gone back up on low volume. It didn't even get to the bottom of the bar. It was too weak. And that thing collapsed. And then all the way down, there are weak bars. Weak bars, look. As the market goes up, there's no volume. Upthrust at point C. Weak bars. So when you see no demand, this is where you short it. This can and does appear in uptrends, but it is far more powerful in a downtrend. Do not short on no demand in an uptrend. It's in the wrong place. This is a powerful short when there is when there's a downtrend in place and price goes up to the top of the downtrend channel on no demand. Look for signs of weakness in the background. This is particularly powerful when seen after the end of a rising market or a buying climax. Okay, TP says, we've come down almost to the low on the Australian dollar, but the Dow has broken its low, which could be the beginning of the other indexes breaking their lows, which also gives a greater odds, I think, the Australian dollar will break its lows, or it would have already. Could you comment on how to read it or other indications in order to make a better decision, or is it just simply take the setup with a stop loss and trade it over and over again? To be honest with you, as I said, I would not be long yet S&P or Aussie dollar, and Tom is not saying go long at the moment. He's watching the volume as the volume tells us. YF is asking, can we recognize the gotcha bars before they happen? Yes, you'll usually see no demand bars, several of them, prior to the gotcha bar. You'll usually see lots of no demand prior to the gotcha bar. That's a real clue. If you see 7 or 8 no demand days in a 2 or 3 week period on a stock, you can almost bet there's going to be a gotcha bar coming. Yeah, so Tom's just looking at the chart there. Okay, now there we go, the gotcha bar, principle 6, the widespread down bar through support. A down bar on a widespread and closing on the low, pushing down and through a previous support level with the next bar down. Now you should have had some sort of up move behind you, and this price action is used to lock you into a poor long trade. You'll very often see no demand after this has happened, and also sometimes before. Okay, so Tom, here's where some people get confused, because they pigeonhole in their heads and their brains
that every time you see ultra-high volume on a down bar, it has to be strong. But, of course, that can't be true. There are times when you get ultra-high volume on a down bar after an uptrend's been in place, and I call them the gotcha bar, which I think is quite an apt description for them. So can you describe to us what is going on a gotcha bar, or as we call it, where the market is marked down rapidly, it closes on the low of the bar and the next bar closes lower, and that usually will mark a turning point in the market. Here's Tom.
Okay, Gav, thanks. Right, a gotcha bar is a very good term for that bar, actually. Gavin came up with that, and I think he's quite accurate. You see, if you're a professional trader, you know automatically how the herd behaves, how the herd thinks. And if you know that there's a point in your trading, or the market's weak, and you've probably distributed, you may have been holding the market up, you know that if you could generate a wide spread down, plummet down, close on the low, right, especially through or towards the former area of support, right, that's what you call a gotcha bar, because you know that people that were hesitating on the previous bars, whether to sell short or go long, are still locked in there. And then it automatically makes them what we call a weak holder. A weak holder is somebody that if they sold right now, they would be losing money. And especially in trading stocks and shares, they don't like that. So they hang on, hoping and praying for some sort of up move to get them out of trouble. But the gotcha bar locks people in, away from the true trade that happened. And I mean, you've probably experienced that. You may have been even wanted to short on a weak market. You may have said, well, I'll just wait and then see what happens. And suddenly you get this huge down spread and you think, oh, well, I missed that. But that's done its purpose as far as professional money is concerned. So they kept you out of a trade where you're to make money that they want to make. They're not there for your benefit. And but those gotcha bars are frequently seen after a sign of weakness, and when you see it, you know why. And of course, if you do get no demand up bar in the vicinity of that, then that's a good place you can get back in the market and short it.
Yeah, thanks, Tom. Lance, I just saw you had a question, so I'm going to open your mic up. I think it was about no demand. Yeah, Lance, what was your question? It was about the previous no demand, was it?
Yeah. Can we go to like that stopping volume again?
No, we're on weakness at the moment. You mean...
Yeah, I've got a question about that stopping volume.
What, on the Australian dollar?
I don't know what it was on.
We haven't done stopping volume on these charts on the PowerPoint. The only place that we've seen stopping volume today potentially was on the Aussie dollar, and we're still waiting for that to be confirmed. There's no trade there yet, but it's starting to accumulate.
No, that chart will do. That'll do.
Yeah.
Shit, I forgot what the question was.
Oh, well, don't worry. Don't worry. Your mic's open, by the way. So, but yeah, don't worry. You can write your question down.
I'm back.
Yeah. Okay.
Right. We're saying that if it comes back down to the low of that bar on low volume, we can take a long. Now, if we go back, is it? And I know everything's possible, but if we go back down to that low of that bar and the volume's healthy, am I right in saying that's going to knock the market sideways then?
Well, we've done it. I mean, look at the chart. The chart doesn't lie. We've come back into this area. Is the volume higher or lower on this bar?
It's lower.
Correct. Is the spread of the bar narrow or wide compared to the spread of that bar?
It's narrower.
It is. So something is capping the market here. Now, has the market changed behaviour, Lance? Has it changed trend yet?
No.
No. But is the likelihood now that it's going to try to do that? Possibly. We don't know yet. But all I know is this is something is holding the market at 1.0220. And that usually infers to me that there are buyers at that level that don't want the price to fall any further. Now, as you quite rightly said, the market is the market. If we get one large or two large groups of traders coming in and they want lower prices, they can put a block sell of orders in and we can push through this level. You don't
Yeah,
know.
but you know what? You know what's doing me head in now?
Uh-huh.
What's confusing me now is, right, you say that test bar is low volume, whereas when I asked the question before, my volume, what I was looking at, what I identified as low, was actually high volume.
Yep.
And that volume there is ultra high volume.
It is, but is it
Now you're comparing it to that bar right at the back.
exactly? Is it? That's the. Where's your Yao Ming bar on the chart? It's there.
You've got it
Right.
there.
Right.
Yeah.
The market comes back down into the area here on very low volume. Yeah, I agree. It's very low there. It's come
But
back.
that's not into the bottom of that very low volume there isn't below the close of the price bar of the Yao Ming bar and below and at the bottom of the bar.
Correct. But what did Tom say? Think about what he said at the beginning. He said, I am waiting, he said, for the market to come back down to this low of the bar. The low was what he said, and the volume to be less than the volume on that bar. That's his statement. Go and check the recording. It's come down to that level, and the volume is still ultra high. There's no doubt about it. But it's less than that volume. And now what we'd expect is the market to come back down again and be even less. And that's called accumulation, Lance. And it's a great question. I'm glad you're asking it, because obviously you're asking the right points here. This is a live chart. I'd love to show you this in hindsight, but this is in foresight. This is actually happening as we speak. What we're seeing here is a large group have come in here to try to hold the market up. The most important part about this bar that you've just seen cut fill live is the spread of the bar. The volume is ultra high still. There's no doubt about it. What I'd like to see now for this market to change is another test of this. So come back down to the bottom of that bar on even lower volume than that bar. And then we're in business. Then the market is trying to accumulate. And then we'll get what we call a spring, which is where the market begins to rally away from this resistance line, and any no supply, as we call them, or low volume down bars at that level will be a trade to the long side. Do you understand that?
I understand, but there's something in my mind where, because you shot down my low volume bar, and it was pretty much the same as that one.
Well, no, I haven't shot. No, I haven't shot it. I haven't shot it down at all. Look at the setup. Remember, when we were looking at your low volume bar, we only had 5 bars of information. We've now got 20 bars of it. Since that bar appeared, we've now got nearly 20 bars of information. Okay, so we're doing this live. I'm not doing this in hindsight. What I'm saying to look for now is a narrow range bar on lower volume than that bar into this area. And it's exactly what Tom said. Now, don't get too wrapped up in your head about, well, went back here, we had, I think the bar you were referring to was that one there. And I said to you, well, that's actually not low volume because it's not like that bar. You're right. It's actually the computer read it as high. That was the bar we were referring to right there. And it is high compared to these other volume bars. And this is definitely high compared to these ones behind it. No doubt about it. But what
And it's higher compared to the one I pointed at.
It is. But what's the interesting... Remember, we're looking to a setup here. That's what you've got to look for. What do you notice about the range of the bar? The spread.
Narrow.
It is. Where does it close? High, middle, or low?
Middle.
And where does the next price bar go? Does it go up or down?
It's pretty much got every single characteristic of the bar I was looking at.
The next bar has gone up. So what does this whole story tell us at the moment, at this moment in time? It tells us that on this bar, we've got Yao Ming volume, okay? Which means some group has tried to stop the price falling further. Do you agree at the moment the price has stopped falling further at that point? Yes or no?
Yeah.
Okay.
Yes.
And then the market is not ready yet to take off. So as Tom said, I'm looking for the market to come back down to the low of that bar and the volume to be less than that bar. That's what he said. The market comes back down to exactly where Tom said, and the volume is definitely less than that volume.
Well,
Definitely.
he actually said on low volume. I'm pretty sure he said he's looking
Okay.
for it to come back down to there on low volume.
On low, okay, and let's assume, I think he said less than that volume, but let me be clear. If it now comes back down to this bar and the volume is lower than that, this is going to tell us that this market's trying to be accumulated. I still wouldn't personally go long yet. I would be a bit more patient. But I think where you're getting a bit wrapped up is you're saying, well, that bar there, Gavin, which was this bar here, which was on this volume, was high volume. And now this bar here is still massive volume, which it is. I'm not disagreeing with you at all. I'm not shooting down your theory at all. But what I'm saying is what we're looking for is the market to keep retesting this 1.0220 area, which it is doing live. That's what's happening. And if we get a setup, it will be when the volume at this level is less than that level and that level. And then we'll know that the market will begin to change behavior. We'll get a change in the diamond colors, and then we can look for long trades. Make sense?
Yeah, I completely get it now. Yeah.
Good. No, great questions, mate. No, listen, mate. I like you challenging me, because the only way to learn this stuff is to ask the questions. And I said at the beginning, there's no such thing as a dumb question when it comes to VSA. You made a very good observation here, but I want you to now look at the setup that's developing. And when we get to signs of strength in part 2, which we're going to take a break shortly, you'll actually see not only a live setup, if it turns up that way. I think this is trying to accumulate. I think there is an opportunity here for us to probably try and see if we can get a long trade in here. But we'll wait and see what happens. But great question, mate. Let me finish off with the PowerPoint and get to the signs of strength. So here, again, we can see no demand in the right place. Okay? No demand. And again here, no demand in the right place, because you've got weakness in the background. Okay? And then let's go back to the gotcha bar. Okay, Tom, in this example of the gotcha bar, which is oil weekly, this was in fact the day, this gotcha bar, when Goldman Sachs analyst Arjun Murthy came out and was telling everybody that oil was going to go to $200 a barrel. And it was actually, I now know, Goldman and several other large institutional banks that then sold to all the willing buyers who'd listened to their fundamental analysis. It's actually quite funny when you see that. Here's another example in Forex. Now look at how the market behaves. Widespread down bar, after an uptrend, closing on the low, next bar closes lower, and then look what happens to the market. It goes up on no demand, look. There's plenty of examples of no demand bars here. And every time the market tries to rally through this level, it's rejected. And eventually, boom, the market takes off to the downside. And you would have to wait a couple of days. Sometimes this is what happens. They hold the market at a certain price level before marking it down further. But these gotcha bars are very powerful because they've taken out the previous support levels. And that's what makes them very powerful. Here's an example. Now this is how the news operates. Now I'll just show you an example of news. So here, food firms warn of sugar shortage is the headline. Now this was back in 2009. I'll never forget this. And this is what actually happened. At bar A, as the news comes out, there's a gotcha bar right there. Bar B is an upthrust. Now this is all done on news. There's a sugar shortage. You'd think that sugar price should rally. But in fact, it doesn't do it at all. Sugar fell about to 22%. So when you see the gotcha bar, as I call it, if you've read my book, hello Steve, I see Steve in here as well. Nice to see you, Steve. When you see a widespread down bar, and it's got to break previous support levels in the background, so there will be some sort of uptrend in price. After you see this sign of weakness, it's confirmed as major weakness if the next bar after the down bar is also closing lower. Okay, and if it's an up bar, it would look like a no demand bar. Most times you will see with these widespread down bars, the first one will close on the low, and then the second one will close shortly after it. We see this very often where you get two lower closes. Now, after you see that, we want the market to change behavior. So when we talk about lower highs, we're talking about changing trend. The market will definitely begin to change behavior, as David Weiss calls it, or change its trend. And as soon as it's changed behavior, you look to short the market when no demand appears or an upthrust appears. These are very powerful shorts. Lance just said he had an aha moment. Cheers, lads. Good. That's the whole idea of learning, is to pick this stuff up. Now, just like the end of a rising market, one of Tom's favourite shorts is the buying climax. Now, this is very easy to read. Now, yesterday, we had a buying climax in the Australian dollar, didn't we? A very clear one. And this is an up bar with wide spreads, so it doesn't have a narrow spread, it's a wide spreads closing in the middle or low on ultra high volume. It's a very powerful sign of weakness if there are no old tops to the left, meaning there's no price action to the left. As a market keeps on going up day after day, a point will be reached at some time when many traders that have sold prematurely or those that are not in the market cannot stand the constant higher prices and the frenzy of buying. And it gives trading syndicates and market makers a golden opportunity to unload large amounts of stock or whatever instrument at a high price without their activity resulting in lower prices. This will mark a high point on the market. Now, last August, can anyone tell me which market had a buying climax? Anyone got any ideas? Last August, a year ago. One particular market exhibited all of this. Yeah, well done, TP. Well done, Dave. It was gold. Gold. The frenzy of buying from the public came in because the public were being told by most news reporters, most financial analysts, that everyone was rushing to the safe haven. How silly. Gold actually traded, I don't know if you remember last week, I forecast that gold would trade down to 1,700. That was my forecast. Let's have a quick look to see if I was anywhere close. Not bad. 1707. Widespread down a few minutes ago. So gold has got some lovely setups here. Should see some no demand bar. There's some buying in gold here. There's a bit of support on the 5-minute chart, but gold is trading down to 1700 and will very likely break 1700. And go and look at my YouTube video last week and you'll see that that was a forecast I made based on the chart. Because what did we see in gold the week before that? The end of a rising market. And that's what caused gold to be sold. Sorry about that. That's a terrible rhyme, but gold was sold, and it was. So the buying climax was seen on the monthly chart of gold. And here is a buying climax. Now, often they'll gap the market up on the news. The news will be good. It will not be bad. It will be good. They will encourage you to be buying. In fact, what they're doing, the smart money, are selling to the uninformed buyers. And all throughout this chart, you have principles. Let me ask you all a question. What is principle B? What do we call that? What is principle B called? Just type in, everyone. Well done, Fiona. I'd expect you to get it. Well done, Daniel. Well done, TP. Well done, Nathan. Well done, Alan, Gerald, Grigory. Yeah, Terry, well done. Gling, Goran, Colin, Ray, 2 Rays, Sean. Yeah, you all got it. It's an upthrust, a hidden upthrust. All right. What is the bar C? What is bar C confirmed on the next bar? Just type it in. What is bar C? Let's see if you're getting this. It's confirmed as well on the very next bar. Oh, you people are VSA experts. You're all going to deserve your certificate when you get it because you're absolutely right. It's no demand at C and there's no demand as well at D. Very good. So, well done, everyone. Well, hello, Lars. I just saw you typing in there. You got it right as well. Well done, Lars. So after you see a buying climax, be cautious because of the momentum of the uptrend behind you. The market can drift up for several bars or you can get upthrusted. A short trade entered at the bottom or low of the buying climax has been broken and then price goes to that area on no demand. Grigory, very well observed, by the way. Grigory says that D has got no confirmation on it. Well spotted, it has. It looks like no demand, and in fact, it's less than the previous 2 bars, but the next bar actually closes up. But I wouldn't be concerned about that because the next bar here and here confirm all this weakness Look at that one. I should probably have put bar D actually on that bar that I'm highlighting, because that's a no demand upthrust, but well done, Gregory. You did spot that, and that's observant. And here you can see on, this was a sugar daily chart, sorry, weekly chart. This was not daily. We see we've got a test at A, and then at bar B, they mark the market down. And let's go to the final principle before we take a break. So we're running a little bit behind, but I hope you don't mind me overrunning. We've got lots to talk about. A top reversal. Now these, you get the same principle at a bottom. We call it a bottom reversal. It's very common, and it's a great place to short. So the first bar gets marked up rapidly by the market maker, closes up on the highs. Usually that's to encourage buyers in. The volume can be high or low, but preferably I like to see it on very high volume. The next bar then rapidly reverses on a wide spread closing on the lows. If the low and the close is lower than the first bar, this adds to the weakness. It gives it more power. As with all these indications, it's important to read the following bars for confirmation of the continued weakness. This sign of weakness is very powerful after an uptrend has been in place for a while. Here's a great example of one. This was on the yen. I actually traded this ages ago, this one. I still remember this. This was one of my first trades with Tom. The market gets marked up on an increase in volume, quite a narrow spread, and then the very next bar, it collapses on the low, and the volume is higher than the previous bar. Now, only one thing can cause that. Supply is overcoming demand there. Sellers are in control there. Then, on the very next bar, we try to go up to the base of this bar, but the volume is now low compared to the previous bars. Then we get a test of this area, which fails. And when you get a failed test, it's a narrow spread bar on low volume, with the next bar closing lower. It's a failed test. But what makes it fail is the weakness on these two bars. Top reversals are very profitable. Now remember, for it really to be powerful, you want to see the bar close lower than the bar behind it. And if it's on an increase in volume, that is a serious, serious sign of weakness. Another example here, lots of examples here, in fact, of weak bars. All of the bars that I've marked are weak bars. You know, when we look at the chart, it's a language. And the language at bar A is the price is marked up, big volume, so there's an effort there, and the result is bar B. That is effort versus result. And you'll notice on the close of bar B, the market never, ever gets higher than the closing price. It tries to go up, and it always closes lower than the reversal. These reversals, learn them. They're very, very powerful. And you will get a copy of our PowerPoint slide when we do the recordings, which will be on Friday. So you'll get a copy of this slide presentation. So after you see this setup, which will very often mark the top, wait for the market to begin trending down, and then you can trade any VSA principle to the short side, which is no demand and upthrusts, or what you tend to see most of after you see a two-bar reversal. All right, and let's summarize. Before you take a short position in the market, ask yourself the following questions. Have you seen a rollover, and is the market in the early stages of a downtrend, or is it still pushing up? You really want to be in the early stages of a downtrend. Is the market falling with no professional support to hold it? Is the low of each bar lower than the previous bar? Remember Tom's simple trending system. You can allow one up bar for every two down bars in a downtrend, as long as the up bar is on low volume. Are you into fresh high ground? What do we mean by that? Well, we mean there's no price action for about 200 bars to the left. Remember, distribution happens on up bars when the market's going up. Ask yourself, are you in a trading range at the moment, or are you actually defining a new trend? Is there lots of good news about the instrument at hand? Remember, professionals sell into good news and buying from the public. Is the market in an overbought or an oversold area of the channel? If you're doing a trend channel, the market becomes vulnerable in an uptrend when the market touches the top line of the channel, and becomes especially vulnerable when ultra-high volume pushes it there. Ask yourself, have you seen two of Tom and my favourite signals, the end of a rising market and the buying climax. And remember, you want to enter the market on an up bar, not a down bar. The only time you would ever enter on a down bar is if you see a gotcha bar, and then almost for sure you could go short without a shadow of a doubt. Okay, someone asked me to put this in. This is for trading the commodities, all the different symbols, for those of you, because some of you said you wanted to trade gold. So I've added this in there for you. And it's got all the symbols and what exchange they trade on, with all the amount of margin you need, the times they open. I think you'll find that quite useful. Graham says the last part has nothing to do with RSI. No, it's not. It's just being overbought. You can use, I don't use RSI, Graham, but I know some traders do to see when a market is being overbought and oversold. But I tend to just use the volume. I know if ultra high volume comes at the top of a trend channel, very likely we're going to see weakness there. All right, let's have a look. What's it, 15? Let's take a break until, what are we, 7:35. Let's come back here at 5 to 8 in the morning UK time, US time. Are you all enjoying this, by the way? Are you getting something out of today's session? By the way, thanks for all your questions that are coming in. We're overrunning a little bit, but there's a lot of great information here. So, I hope you're learning from it, and I certainly enjoy doing this, as you can tell. And so just good. Okay, everyone says they're very happy. That's what we like. We like happy customers. Quick, stuff them. Put them in a museum. Oh, yeah. Happy customers. All right, we'll be back in. We're going to have a cup of tea, cup of cha, and we'll see you here at 5 to 8 to resume part 2 on the signs of strength. And welcome back to everybody for part 2. It's just put both my backup recordings on. And, we're just looking at this chart, Tom and I, of the Australian dollar. I'll get Tom's opinion. You've got a lot of signals coming in on these down bars. And the market, you see, this one is the last bar that we've got. Massive volume. But Tom is still hesitant to think about taking a long trade because of the high volume around. When there's high volume anywhere, it tells you that there's still supply present. And that needs to be tested. Here's Tom to tell us about the chart.
Well, we're certainly not interested in a long position at the moment. We saw way over to the left of the 5-minute chart I'm looking at what looked like stopping volume. Sorry, well, I'm looking at the 15-minute actually. We saw definitely what we call stopping volume, right? And then the market did roll over slightly, and we did see a sort of test. There's even a signal come up on it. Yeah. However, the market has not responded to that, which you should realize that is a sign of weakness really built into the software in its own right. See, if you get a green signal of strength, right, and nothing happens, then you could be rest assured that the market is weak, so weak it can't take advantage of what brought that signal up. And there must have been a reason why it came up there. So we're certainly just watching it now. The S&P will be opening in about half hour or so. Okay, so we'll certainly watch that. But always be cautious when you see too much supply around. And I'm looking at this 50-minute chart now, and the more or less the previous bar is very, very high volume. So it's definitely supply there. Now, it may be stopping volume, but if it is genuine stopping volume, right, and it's quite possible sometimes the markets have accumulated so many short positions that sometimes take time to absorb all that weakness and turn around and become strong. But if we see a test, then that would be the okay, a proper test on really low volume, then that would be okay to go long. But you always be ultra cautious when you see this terrific high volume like this, because there is supply there. And if it is genuinely bullish, they will test sometime in the future.
Thank you, Tom. Morris, I didn't see your question about the GLD chart. You'll need to retype it, sorry. Unless you've got a microphone, you can ask the question to us directly, whatever you want. But I didn't see that question. Sorry, Morris, I can't find it in the chat window. US session will be open in 30 minutes, says Gregory. If the setup will come before it, would you take a trade? I don't like to trade into the open, but if it's there, it's there. I don't think it will be, though. There's too much volume around. Something's going on, though. What's the difference between this Aussie trade and gold, which was a very similar setup, much like all the indices, but with gold you have some insight that tells you think that it's probable that gold will break the lows then go lower. What tells you that, and what on the Aussie dollar says that isn't as likely to happen, and therefore you're looking for a test? Okay, I personally have been short the Aussie dollar over the last week or two, and yesterday you saw me take a short. Okay, now we've got this volume coming in, and I do think we'll break out of our range on the Aussie dollar, because if I look at the 5-minute chart, here we go. Now we're trying to push up through there. Now what I'm looking for is, when I see this very high volume like this, I count 25 bars across. Now there's a reason for that I can't reveal here, but it's to do with the hedge fund software. And if the market in 25 bars has not broken into a new trend, it means it's still weak. But look, already we're seeing a bit of volume coming in here. Now, when it takes out that 0232, I'll go to a shorter time frame. I may even go, in fact, it's doing it now. Let's go and have a quick look. Sorry, I want to get to the PowerPoint, but we also want to see, it's starting to respond now, isn't it, to all this accumulation that we've seen. And now it's you're going to have high volume on this up bar, trying to push through that resistance level, and then any test, any no supply bar would be a place to potentially go long here, because you've got accumulation happening. So now we've got some reaction to what Tom was expecting. But this is where you've got to be a bit careful, because they're devious. Okay, if they want lower prices, right, and they want to mark the market down further, you may well see upthrusts. I'm just saying that, as this bar could well be an upthrust. So we've got to be a bit careful now, because there's a lot of volume. There must be some news come out. Let me go and have a quick look. I wasn't going to make today into a live trading session. It was supposed to be for Friday. But anyway, let's just go and have a quick look. Okay, so you've got there'll be some news on the Canadian dollar. There's no major news announcement really that should be causing this volume to come in, so something's happening. Yeah, and we've got half an hour to the open. So, all right, well, look, we'll watch it. We'll watch it and see. Now, Morris has a question. GLD had a no demand up bar yesterday, but the previous day showed some strength. Would you cover a short on that strength? But then would you reshort on the no demand if the previous bar is strong? Okay, so you're looking at a daily chart, Morris. What I would do is go down to another time frame and see what I see. So let's go and have a look at the GLD chart that you're referring to. Okay, and what do I notice? Well, a couple of things are evident. Here's your weakness in the background. Here's your change in behavior in the market. They're testing the low of that bar. That's what we're seeing there, is a test of that bar. I would prefer now, I mean, I don't trade GLD, I trade the futures contract, because you do tend to get quite a lot of gaps. But no, I think this bar here and this bar here is the telltale sign that there's sellers there. I would wait for the market now to break the low of this bar. If it does, then we'll have a further retracement back down to this level. But if we look at the futures contract there, it's the same thing. It's come back down. I know today on the smaller time frame, it's trying to go down to this round number at 1700. So I'd certainly be wanting to see if it gets down that far. So I'd use a different time frame here, Morris. And in fact, what I do is just go to the 15-minute chart now and see where gold's, we've seen some support down here. Where's the low? It got down to 1706. There's an upthrust there. You've got a little bit of support here. But if this goes up on no demand, then I think we'll see lower prices here. There is some support for gold. There is definitely some buying here. But in this strong downtrend, if we go up here to the top of that bar on no demand, then we will see 1700 gold in the next 48 hours, almost definitely. The market is not already open in the US. No, it opens at 8:30, Fiona. It opens at 8:30. Okay, so volume spread analysis, signs of strength. Tom, what defines strength in the market when we use VSA? What are we looking for?
Right. You will see signs of strength entering the market. Definitely in some or more of the time frames. I was looking at the, I don't know how many of you read my newsletter, but I was discussing the fact is that last week, before Friday that is, the market was marked up definitely 2 bars widespread up. And I couldn't really see a cause at the bottom for it. As a matter of fact, it was only 3 bars in front of the immediate move up. And all 3 bars, to me, looked weak. They didn't look very strong. So I was wondering, knowing that they had to have a cause to go up. So I went down to the 1 hour, and lo and behold, there it was. You could see if you looked at the 1 hour chart, which I put up in the newsletter, that there was on the day before the up move, we had a sign of strength come in, which was stopping volume. In other words, the market's been falling, and then you get a red down bar, falls into fresh low ground after there's been quite a substantial decline, and suddenly you see this huge volume coming in. And sometimes the market closes in the middle. If it does, that adds more strength. Sometimes closing a low. But that's where the strength came in. It jostled sideways for a bit, tested, and that's the reason why we had those 2 or 3 rapid moves up. But the whole thing didn't look good to me. It looked artificial. As I saw, more or less, it didn't look proper to me at all. And then, of course, Friday, the market plummeted down on a real widespread, and that's built-in weakness in the S&P 500 there. But strength will have to appear before you get a turnaround from a weak market or a falling market to a strong market. And because the market is really devious and cunning, sometimes you'll see the stopping volume and you're waiting like we did today on the Australian dollar. We saw stopping volume come in, but there wasn't any much response there. It arced over slightly like a mushroom. It did actually test at one time, but there was no results. That's not usually a good sign at the moment. There was too much volume there. And I see now the market looks weak at the moment, to be quite honest, to me. This Australian dollar, it's gone up. Volume's very, very high. And the next bar's down. Looks like what we call a top reversal, which can be a sign of weakness. It's very common in these weak markets to see this sort of thing. But for as far as strength is concerned, you need to check these different time frames, because sometimes it's not all that obvious. Sometimes the daily chart, you see definitely the high volume coming in, right? Sometimes the signal is so clear that you can trade off the end of day chart, daily chart. But I find looking at the pound and then perhaps the 15-minute is very, very useful, especially that 1 hour chart. Gives them a chance to show you their hand, their accumulation, which would be what we call stopping volume. It'd be high volume in down bar. It may close off a low or in the middle, and next bar is usually not down, it's usually holding. That means we've got stopping volume. But we don't go long on that. We need to see that test of that area, the test where the volume is clearly low, telling us that supply that was present. See, when you see stopping volume, the high volume means that there's supply there. Of course there is. They're covering all their short positions, they're buying and all the rest of it. The public are being shaken out, one thing or another. Okay, so that's stopping volume, but that needs to be tested because it shows there is supply there. Now I'm looking at this Aussie dollar. It certainly looks weak at the moment. That looks like a top reversal, doesn't it, Gav? Are you watching it?
Yeah, we've got a reversal reversal there. It's produced a signal, actually. There's a lot of weakness.
Oh, yeah. But we've seen the weakness. That's why we were reluctant to go long. So there's just too much volume around. Markets don't like all that volume because high volume, high activity means that there's supply around. And it's supply that's the big enemy to a professional trader, because if they're trying to generate a move up and there's supply there in the background, and other professionals will start or may unload their holdings onto another lot of professionals, and they will lose money. So they all have to be pretty cautious and clever about what they do here.
If you see no demand anywhere now, you should probably short it.
Well, I mean, this definitely looks like a weak bar, 2 bars now. Only a really weak market will do this. I mean, Gavin's been saying the thing's trending down.
Yeah, let me just explain. You know, we didn't see the market change behaviour. In fact, we've seen it confirm its weakness. I've been saying for days that the market's going to 1.0200, and I don't think I'm wrong on that. I think I'm right. But if I see no demand here, especially now the market's fallen, and we've got this big serious sign of weakness, then yeah, I'd probably consider shorting this now, because this here has not changed the behaviour of the market. And I've made some very nice short trades on this, and it's still trending down. And some group or groups came in and tried to hold this market up. But this is a very large set of orders that have come in. They've marked it up to that line. It never went through it. And look at the effort versus result now. That's all we've got to look at. Effort versus result. The effort was enormous. The result was an immediate down bar. And again, if you get no demand now, as the market starts to trend down with red bars, you know, there's a trade down there, down to 1.0200. Okay, let's focus on signs of strength, though. So what is a sign of strength? Well, it usually happens on a down bar. Especially powerful if the spread of the bar is narrow. The price can close in the middle, the low, or in fact on the high. Sometimes you do see the price close on the high. The volume can be high or low, and we know that's true. It's true because the high volume is what we see coming in, and then we're looking for the low volume test to confirm that the market's bullish. A narrow spread on a bar, especially on a down bar with very high volume, is a very powerful signal to go long. We call it bag holding, and we're going to show you that. Buying will prevent any effort for the market to move up. If you see ultra high volume on a down bar, again, it's like the up bar. It's a trap. What are the smart money doing? If professionals have got no interest in downward price, you'll get low volume as the market falls. If they're buying into the public selling, you're going to start to see higher volume. High plus volume shows demand coming in. Public are selling. Smart money are buying. This is what happened to British Petroleum in 2010. The panic selling came in because of the news, and the smart money began to buy. And then after they bought, as the market fell a few days later, the volume was very low, and that is because there was now no supply. They'd taken control of BP's stock, and that stock went up. All right, so a bottom reversal. This is one of the principles. It's the complete opposite of a top reversal. And it's a widespread down bar closing on the low. The low in the close is lower than the previous 4 bars, followed by an up bar on a wide plus spread closing on the highs. Now this arrives in a variety of versions, and what I mean by that, they don't all look exactly the same, but the principle is the same. Okay, but basically the first down bar is what we call the shakeout. That's to get everybody out of their long positions. And usually there'll be some sort of bad news if it's associated with a stock. Okay, the second bar is then rapidly marked up. So now if you're shorted, you're locked in or out of a trade, depending on whether you're short or long. So people hesitate now because they see this big wide spread and they're not sure what to do. But this is a great example on my favourite stock, JP Morgan. And this actually changed the trend of the market. It completely reversed the trend. Look at the volume that's associated with the reversal. And again, you're looking for the closing price to be higher than the bar behind it. That's important. That adds to the strength. Now, very often you'll see some sort of test after this, but in this instance, the market just rallied away. But what happens is when the market does retrace, look for the narrowing of the spreads and the low volume, and that's confirming that the buying is in control, and that thing just shot up to $50. So Tom, tell us, the bottom reversal is a strong sign of strength. It's almost like a violent shakeout, really, but can you just explain what's going on?
Well, the bottom reversal is a serious sign of strength. It's really a form of shakeout, isn't it? They mark the price down heavily, the first bar. You see the volume has increased substantially. The news has probably come out of some sort, which will be so-called bad news, right? Something's happened somewhere or other. You do get influenced by the news. That's the problem, because your mind is constantly absorbing all this information pouring in. I mean, we sit here in England and look at the news, and they love these days to put the weather forecast up. You know, it's like a feature now, lasts 5 minutes or more. Okay, but what's interesting is that sometimes they're standing in front of this screen with a map of England in this case, and the way they're talking, you think the end of the world's coming to, say, Scotland or somewhere. And you think, oh my God, look, there's big arrows and there's gales blowing and there's this happening and that's happening, right? But many times after that, if you speak to somebody up in Scotland, say, well, the weather, oh no, it's quite nice actually, you know. It happened here in Worthing. I remember watching the news one night, the weather forecast, and there was a hell of a gale predicted. This was going to happen, that was going to happen. Terrible thing. There was all these big arrows and lines they draw, right? But during the night, it rained for about half an hour, and that was it. So, you see, there's no news in good news. You know, there's no news in saying, oh, the weather's going to be fine, you can walk along the seafront, enjoy yourself, and have a nice ice cream, and there's no news in that. What they want for news is disasters, as close as possible. And they do the same thing when they're talking about the stock market. I mean, I've seen them. I mean, when I was in the syndicate, we used to have reporters on our list that we knew we could phone up and give them a story and they'd publish it. Because the reporter loves that. It's some information from them to write about. But of course it's written by us. And of course it would be highly geared to benefit our trading. So that goes on, believe me. That definitely goes on. So be very, very cautious about the news. And why do you think they let you know in advance when all the news is coming out? They might say today, oh yeah, the news coming out at 3 o'clock about this or that or something. Why are they so keen to tell you all that when there's definitely, they're not there to help you, the exchanges or the market, definitely not there. They'll help their members perhaps, but they certainly won't be wanting to help you. So why they appear to be helping you by telling you all the times and the dates that the news is coming out? Because they whipsaw the market, or can whipsaw the market on that news to their benefit, not yours. And you see that all the time. So, but it's very, very interesting. It's a fascinating subject, and I love it. Gavin loves it. And I'm sure once you get to read these charts, right, you'll never look back at all.
No, that is very true, Tom. So here's a good example, look, of a reversal. And again, you'll often see these happening, especially in the currencies. They do this, where the widespread down, next bar closes up or near the top of the bar. So when you see the bottom reversal, okay, there'll probably have been a downtrend behind you. Wait to make at least 3 higher lows on the bar, meaning price action is moving up. Then look to enter on a low volume down bar, a test, no supply, or my favorite signal, which we'll get to, a test in a rising market. Now this Aussie dollar is not looking strong at all at the moment. It's trying to climb. I'm almost tempted to take a short trade now on that. Yeah. I'm almost, you know, as I say, I want to focus on this seminar, but you know, I just want to show you the principle here. Let's just jump over to it. I hope you don't mind, but it's something that's happening live now. We did say we'd look at live charts. So here is almost a reversal. Okay, now this bar didn't even make it up that high. In fact, let me just put that in. Okay. 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 No, this is interesting because what we see on this bar here and this bar here is the market's tried to be accumulated. We know that they've tried to buy some down here, but that volume is extremely high. Markets just don't like very, very, very high volume like that. And we are approaching a round number, 1.0200. And the market often gets drawn to that round number. So if that was all buying volume, you wouldn't expect the next bar to do that. And then we've got a no demand upthrust that's right there. So this doesn't look strong at all at the moment for those of you that are following it. If anything, it looks weak. So after you see the bottom reversal, look for the test, okay? The test is the key. You'll find that these low volume bars are actually key to your success as a trader, because after you see ultra high volume, that's your activity, then you're looking for the confirmation of the low activity. What do the white diamonds tell me? They tell me, William, that the market's going into congestion at that moment. That's what the diamonds tell me. They tell me that the market is going into congestion. And Colin's telling me that we're seeing on a 3-minute chart a potential climatic action bar, sign of weakness 1. Well, we talked about that. So we'll see what happens. We'll see what the market does on all this volume. All right, okay. Now, the simple trending system that Tom uses to stay in a trend, or in a trade rather, is very similar to the one that we talked about when Tom was talking about the downtrend. This is just the complete opposite. Now, Wyckoff explained to us that in a strong market, you get increasing but not excessive volume on up bars and decreasing volume on down bars. So when you trade and you're long, make sure you've first seen a serious sign of strength. It could be a bottom reversal, it could be a climactic bar, but it'll probably be on ultra high volume. Shakeouts are especially powerful, and we'll come to that signal shortly. And remember, after you see the shakeout, you're going to start looking for confirmation of the strength in the market. And then I wait for about 10 bars to see the result of the strength. Now that saved me this morning because I wasn't going to try and take a long trade. And in fact, we didn't see a result within 10 bars. We didn't even see it within 25 bars. So we didn't see the result of where that weakness came in. So always look to see if the market changes behavior. That's important. Now, in a strong uptrend, this is very important, this bit, we should see decreasing volume, but not excessive or ultra high on the down bars, and increasing volume on up bars. Okay, but not excessive. You don't want to see ultra high volume anywhere, because ultra high volume probably means there's supply present. Okay, in an uptrend, you can allow for one down bar if they are on low to average volume. Ignore level bars or near level bars. That is a bar that is closed at or near the same price level. The end of the uptrend is often seen by 2 consecutive down bars followed by no demand. And if you've got the software, we have these colors in the software that you can switch on by clicking there, which show you when you're in a defined uptrend or downtrend. Now this chart is in a downtrend at the moment. It's in a clear, defined downtrend with an attempt to hold the market up and some weakness, some supply that hit the market here. If we look at a chart that's in an uptrend, let's go and have a look at let's try Apple, because I know that has been in an uptrend for quite a long time. you'll see here, if we go to 100 bars, as the market trends up, look, okay, here's your up bars, and you can allow 2 down bars as long as the volume is low on each down bar. There's the up bar, the up bar, the up bar, the up bar. You allow 1 down bar here, no problem. You can allow for 2 down bars as long as they're on low volume. Up bar, up bar, up bar, 1 down bar. Up bar, 1 down bar. Up bar, up bar. Now here, we have 2 down bars on very low volume. Then you get the 3rd down bar. That's where you would start to watch your stop. If that next bar had closed down, you probably would have come out the trade, but it didn't. It closed up. Up, 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 up. Then we get some more signs of weakness at the top. And on this 3rd down bar here is where you close your trade, because you've had 3 consecutive down bars, but the 2nd down bar is on increasing or high volume compared to this down bar. So you've got increasing volume on the down bars here, here, and here. You see that? And that defines that that trend has ended. And it's a very straightforward trending system. And it keeps you in the trade a lot longer than you think you're going to be in it. A lot longer. Yeah, and so that's what the volume thermometer does. Exactly that. Yep.
It's average, that's what I don't like.
Yep. Okay, so principle 2, stopping volume. Now you see stopping volume a lot. It happens in strong markets, which is a great place to have it, but it also happens in weak markets. So to stop a down move, demand has to overcome supply. As a market falls day after day, a point will be reached when the herd cannot stand the losses, so they all tend to panic at the same time. If the price levels reached are now attractive to a professional, they will step in and start buying. This activity causes a surge in volume as they buy and cover their short positions. So Grigory says, if professional money are reaccumulating on the uptrend, will we then have ultra-high volume on down bars, or still has to be average? It's a good question. You usually see average volume on the down bars because they don't want to, if they are accumulating, they don't want to let everyone know they're accumulating. You know, ultra-high volume to a professional trader is like a, what's the right word, a telegram. They don't want to telegraph what they're doing. If they can help it, they don't want to telegraph what they're doing. And that is why when they accumulate, they do so on down bars, absolutely. But I tend to look in an uptrend. The first thing I look for, Grigory, is the shakeout or bag holding. And then, as you'll see with that particular signal, you'll get stopping volume coming in as the market pushes up and retraces because they're actually buying on the down moves. Here's a good example. So here we can see the market's in a clear uptrend, and notice as it falls, we suddenly see high volume coming in on this down bar, but the next bar closes higher, and that is stopping volume in an uptrend. You see this quite frequently if the market's going to be bullish, and sure enough, that continues and goes up. So when we see ultra high volume narrow spread down bars in an uptrend and the next bar is up, that will produce a signal in the software called stopping volume. And stopping volume does exactly that. It stops the market in its tracks and then allows them to buy at lower prices. So it's, in fact, Gling says it's reaccumulation in an uptrend. Yeah. Is it still okay if the confirmation bar to VSA signals are on low volume? Yes, that'd still be okay too. But this one is quite obvious. When you see a retracement in an uptrend like that, and the volume suddenly gets very high, narrow spread, next bar closes up, that is stopping volume. Okay, Tom, stopping volume. We see this all the time in Trade Guide, and sometimes it stops the market dead and it changes, and other times it keeps going. Now, we've seen some stopping volume today in the Aussie dollar, and if we look at that chart of the Aussie, we'll see what the market actually did on that volume. You see, and it's quite interesting. There is, at the moment, another signal. We've got your stopping volume back here. Okay, so you've got climactic action. Here, there's stopping volume. So there's definitely there. The signal can't be wrong because the market went up, didn't go down. Here, we have a test of that. But then we get this surge of volume going up. It comes to the top of this bar, rejects price, And now we're going back up there on what I was looking for, no demand. Okay, and if that stays like that, we get a confirmation of no demand, then we should see lower prices. Now, once it takes out that low, if it does so at the open, which is about to open now, if it does take out that low, that market will rapidly go down to 1.0220, but, sorry, 1.000. However, got some interesting principles on this chart. The Aussie dollar is going sort of sideways at the moment. The no demand got confirmed. I've got more weakness than strength in the background. This is a battle between bulls and bears on this last chart. But the bulls are trying to hold the market up. The bears are trying to force the price down. I think the Bears might win this, as I say. I'm a Chicago Bears fan, so there looks to me here to be an opportunity here for this to push lower. And then my target, my trigger is 1.0222. I'd have a target down there of about 25 ticks. So now the US is open, we'll see if the market reacts accordingly. But Tom, stopping volume. Okay, this is another good example of it. Almost a big down move. Stopping volume and shakeouts tend to do the same thing. They mark the market down on stopping volume to buy more. Here's Tom who'll explain stopping volume.
Yeah, thanks. Stopping volume is more or less that's why we call it stopping volume, is that when you see a down move in the background, and one, it'd be on the down bar, and it's usually the fresh low ground, and you see that it's rammed down. It could be on some bad news or so-called bad news, right? But at the end of the bar, it's probably closed in the middle. Doesn't have to, but it may have done. The volume is the main thing. It's ultra high, so you definitely know that there's been an attempt to stop the market falling. Some groups or group has moved into the market, right, absorbed the panic selling from those weak holders that have ridden that down, and there will be a point reached, which is well known, that the herd as a whole tends to panic at a similar time, and they dump their holdings, professional money move in and absorb that. And of course, classic example of that was 9/11, when the market had been closed for a whole week. When it reopened, of course, all the news was bad, right? It plummeted down. Okay, you saw the volume was ultra high. The newscasters were looking grim-faced, looking at you, telling you how billions of dollars have been wiped off the share values. Al-Qaeda cells, according to the president, even he spoke to you, is all dotted around. You're either with us or against us. All this terrible bad news. Right, and they looked at that, and the inference of all that bad news was, of course, lower prices. I believe they even said expect lower prices. But although, because you know more about the market than they do, what they should have said on the end of that broadcast, however, don't be alarmed, right? Everything looks gloomy at the moment, but we've got people on the floor of the New York Stock Exchange, and they tell us that everybody, every trader there is buying everything they get their hands hold of. So that will make the market a strong market rather than a weak market. But they don't tell you that. They give you all the bad news. And they're not told that last bit about all their traders absorbing. Even though some of those TV programs have, one of them I know has a lady standing there in a busy part of the trading floor where all telephones are, looking up at the camera, which must be on a balcony. And she's in a high-pitched voice rattling all these figures and numbers and things that are completely meaningless to a trader, really. And but the thing is, it's what they call the halo effect, because you as a viewer of that TV program think, oh, they've got somebody on the floor of the exchange. Oh, if something happens, she'll find out straight away and let us know. But believe me, that lady on the floor would be the last probably person to be told anything. They will not tell her anything. I can assure you that. But they call that the halo effect. But it all there works all on supply and demand. But keep studying it, looking at it, and in time you'll definitely see the picture the way we do.
Yeah, thanks, Tom. Okay. All right, so there, stopping volume. We do like to look at 2 bars, Lance. That's correct. You want confirmation of the stopping volume. And there is the confirmation at bar B. And very often you'll see at bar C, the market is tested. You very often see that. So bar A is your stopping volume. Bar B is confirmation that there must be demand overcoming supply. Bar C is the test. And again, bar D. And the market goes up. Here's another example here, look. We get the stopping volume. This, Lance, is exactly what we were talking about earlier where you had a question about the volume. There's the very high volume. The market returns to that area and the volume is low. And finally, it gets back down to that area yet again and the volume is almost non-existent. That hasn't happened in the Aussie dollar at the moment at all. But that setup did not materialize. Yeah. Yeah, Thomas says, I'll get him to talk about that. Thomas says, Tom mentioned a while ago that the new volume thermometer might be good enough to actually trade on. Okay, so I'm just having a look at this Aussie chart here. Okay. Yes, the volume thermometer, Tom. Tell us more about it. You said you could actually trade off it. It was that good. Maybe you could explain.
Well, the vertical thermometer you see on the right-hand side of your screen with the software is in fact following the principle that Wyckoff stated out over 100 years ago. He said that bullish volume is increasing volume on up bars while decreasing on down bars. Bearish volume is the opposite. Bearish volume is increasing volume on down bars while decreasing on up bars. And for that reason, it's in a weak market. If it's decreasing on up bars, that's why you get no demand. That's why you get up thrusts with no volume. And of course, a bullish market, if it's decreasing on down bars of volume, that's why you get tests that show the market is strong. Now, I was never really happy with that thermometer at the side because the way it was programmed in, it had to be averaged by about 2 or possibly 3 bars. Now, I don't like things average because I believe in spot decisions. You could see something happening and then your skill as a trader has to decide what you want to do about it. That might vary, yes. But the new thermometer doesn't do that. It's actually live on each bar. And with advances in programming and advances in my knowledge as well, we've been able to do that. And although it was developed some time ago now, but it's only because of these new programmers that Gavin have and been able to put them into at least Metastock. I haven't actually seen it, but I've seen the test program I did on it, and it was surprisingly accurate. And it was very, very accurate. And I said at the time, you could trade on that. It was so accurate. But it would certainly be a real good hand holder. And you certainly wouldn't want to go against that.
Can you just let everyone know we're doing a special seminar with Metastock 12 next week to show them the thermometer?
Right. Gavin just said that you're doing a special seminar with Metastock on the 12th?
No, it's going to be next week, I think. Next Wednesday. Yeah, I think next Wednesday.
Next Wednesday.
Yeah, and we'll show it.
Where you'll be actually seeing this new thermometer. And it's not based on any crafty secrets. It's not based on any mathematical formulas. It's based on actually the computer's good at this. Human beings aren't very good at summing up long strings of data. They find it, well, it's virtually impossible to do, but computers love all that sort of stuff. And that's why it comes up with this incredible accuracy about bullish or bearish volume. And so if you look forward to seeing that working in Metastock plugin next Wednesday. So we look forward to that.
Yeah, you'll all get an email from us. Metastock are doing the actual seminar. So just to summarise, if you're going to go long after you've seen stopping volume, then when smart money or professionals accumulate, okay, you will see it beginning on high volume down bars. But the accumulation phase takes time. Do not try to buy the bottom after seeing stopping volume. Wait for the market to drift up, then come back down into the area of stopping volume on low volume. And Lance, this is what we showed earlier. The lower the better. If the spread is narrow and the market makes two higher lows within 25 bars, this confirms the long position. Enter on any low volume bar after this. Place a buy order above the low volume bar. Okay, let the market come to you. This is called a successful test. Okay. Yes, Nathan, I know that a lot of people in Trade Guider want to see the new thermometer in the software, and we're working on that. That will happen. But initially we tested it in Metastock with great success, and I can't show you it today, but I will show you it tomorrow. I'll have it here, and you'll be able to see it. TV says the indices have gap professionally open, meaning it's so large it's highly probable it will continue to be a runaway gap in the direction of the gap, which is to the downside. Okay, I'm just reading all of your comments there. Yeah, no, I've noticed that too. There is, just so you know, on the Australian dollar short there, this is a key level for me. If we get down below that, this was the no demand I was looking for. Okay, so there's your no demand bar. Okay, and for those of you that are interested here, I said my trigger was at 22, and that's exactly where I took my trade. So I'm focusing on teaching you today, but there was a short on the no demand there, and that's a grade 2 trade. And if it breaks these support line there, what you're going to see, very, very likely, is if it holds down here, is a movement down to around 1.200, which is where my target would be. Okay, and I've got my stop just up here at 39. All right. So yeah, let's carry on with the PowerPoint slide. As I said, we've got more live trading. We're going to do it on Friday, just so you know. And let's start with number 3. Okay, the tests and types of tests. Now, this really does seem to confuse a lot of you, the tests. I'm not sure why it's confusing, but it does appear to be a confusing principle for many. So when we see a test, they're testing something, okay? And a test works best, excuse the rhyming here, but a test works best after some sort of sign of strength. So Tom, many traders email me and tell me they don't understand testing. Could you explain it?
Well, okay, Gareth, thanks. The biggest danger is if you're a professional player, is that once you've generated, say, you may have moved in the market, we've seen stopping volume, we've seen a whatever, and the market's going up. Now, the biggest danger to you, if you're a professional, is that you will lose control of your full move. Remember, they do orchestrate it by making sure the close is higher than the close of the previous bar, so it's constantly moving up, right? But this may, at times, cost them money. But the biggest danger is they don't want other professionals dumping, which you do see occasionally. You see an up move, you see a red arrow appear, and that red arrow forces the market sideways, could be going sideways for even a week or two. And that's because some group has dumped their holdings. And it takes time for the stronger group to get control back in there and take it up to another level. But that's what they don't like. However, when they're moving up like that, they will frequently do what we call a test. A test is a down bar, narrow spread, usually closing in the middle, and the volume is less than the previous 2 bars. If you've got bullish activity behind your up move, that's the time that you can jump in the market and go long. Don't hesitate, because that's a very bullish sign, right? Especially when you've got strength in the background behind you. And that's what we call a test. I described it yesterday, as you know. If you're a general in the Second World War sitting in your tent and you're trying to capture a town 2 or 3 miles ahead, you've bombarded the hell out of it for several days, right? You sent your aircraft in and bombed it and all the rest of it. But you as a general, right, you want to know if the enemy has been taken out of that town, or they lie there well hidden waiting for you. That's the main thing. So what does he do? He sends an SAS type of column. You know, they blacken their face, and there's usually about 6, 7 of them, and they go off in a single file towards the town, and they go into the town if possible and start looking around. They want to know if the enemy is still entrenched there, if they're still there, because that's the biggest danger to that poor general. He sends his men to attack that town, and the enemy's still embedded there. And so that's like supply to the professionals. Okay, but if the column then reports back and says to the general, right, okay, the enemy has fled, right, your bombardment has driven them out. So you then, general, say, right, okay, I can send my troops in. But that's a test of supply. And the same thing goes on in the market. Very interesting.
All right, so let's have a look at some examples. So this is a very common sign of strength, and it's frequently seen just before an up move takes place. The opposite of a test is no demand, by the way. That's the opposite. Okay, a test is doing exactly what it says. It's testing something. It's testing supply. Okay, it's testing for supply. Too much supply, the market's going to fall. If there's no more supply, the market can go up. If there's still too much supply, a test can fail. And if you see a failed test in a weak market, it confirms that the market will continue to fall. Tests need 2 bars to confirm the strength. Remember, a test can fail. So keep that in mind. So we wait for the next bar to close higher to confirm the strength. Remember, tests must have strength in the background, buying. If you have weakness in the background and you see a test and the next bar is down, this is a strong sign of additional weakness, not strength, and we actually call it a failed test. Here is a great example on Goldman Sachs of a lovely test in a rising market, one of my favourite signals. It was at the bottom of the trend channel, or the bottom of the trend. The volume was low, narrow spread, next bar closed up, and Goldman just kept going to 400, in fact. It was a very nice setup indeed. Very, very nice indeed. And that's what we call a test. And tests always work best when you've got sort of strength in the background. Here is the strength, as you can see on this chart. Widespread down, we close level, the market comes down, tests that area, look at the volume at this level, it's now very, very low, and Lance, that's what we're looking for, very low volume here, and the market then springs and begins its rally. So we see tests a lot. Here's a great example of an immediate test. This was in Barclays. The news was very, very bad. The news was negative, and guess what? This responded very positively. Now we see stopping volume, massive, massive volume here. The market at point A tests. It then responds at point B. Whoops. At point B. But once the market goes through this level, you'll get testing of all of these high volume bars before the market's ready to move up. And that happens frequently. And then the market moves away from that area. So when we look for testing, it starts with ultra high volume, and then the low volume into the same area is professionals testing for supply. Here on this example, we see multiple tests in a rising market. Remember, tests work best in a rising market. They work best when there's strength in the background. And my favourite setups was indeed the test in a rising market. You see these happening a lot. So when you see a test, you must have strength in the background, such as stopping volume or climactic action. Place a stop under the low of that. Do you get tests on a downsiding market? Oh yes, you do actually. Do you want to talk about that? You see tests as the market's weak and they fail. Do you want to talk about that?
Well, you do see what we call a fail test, and but the fail test will occur when you've got obvious weakness in the background. And for various reasons, we're not asking any questions. It may look like a test. It may have fallen a narrow spread, closed in the middle, and the volume may be low. But next bar's reluctant to go up, and that means it's a fail test. Because believe me, if that was a genuine test and professional money was there poised, they would jump in immediately and they would be long on that test. But they're not long because they're weak. There's weakness in the background, and you see that very, very often. Funny, I'm looking at this Australian, and sure enough, there's no demand signal appeared automatically up there. So, and that appeared after we were discussing what was liable to happen. So it's all very, very interesting.
Oh yeah, no, I'm showing the people on the chart there the sign of weakness that appeared, and there's what happened. We had a high volume up bar, next bar closed lower, and now they're actually testing the low of this bar, which is quite interesting on that line. Where this chart will take off is when it takes out that low. When it pushes down below the low of 212, then you get a big surge down through to 1.02000. Yeah, now, but that will be in harmony with the trend of price, and will be in harmony with that weakness there. So we've got to see if it happens. That's what we've got to watch for. Okay, this is going well. Good. Absorption volume. Now, we've already been asked several questions about this today, and absorption volume happens. It's the opposite of a gotcha bar. Okay, it's the opposite of a gotcha bar. It's where professional money are bullish, and they're quite prepared to absorb any sellers to the left. And this is demand, basically. It will very often produce a red signal because the market goes up on high volume. But this is a very important point. If you see the market tested within 3 or 4 bars of seeing this ultra high volume like this, then it's a very strong sign of strength, especially in a bull market. So Tom, absorption volume, I see this a lot, certainly the last few months in the S&P where they mark it up. Now we've had a sell-off in the S&P, which we expected, but we certainly see absorption volume. And I've got an example here of the British pound 4-hour chart where you've got a clear resistance line. Suddenly the market surges up on very high volume, but 3 bars later, look, and in fact here you've got 2 tests and the market responds and it keeps going. So what's going on when we talk about absorption volume?
It's all very, very logical if you realize that you're looking at the action of professional traders. Now, whenever you see the market churning sideways or maybe rolling over a little bit, and you've traded and you're in there, you may have a long position, right? So you're sitting there and suddenly, right, the market falls for 2 or 3 bars, perhaps. Now, you're not at all happy because you've now suddenly become what we call a weak holder. In other words, if you sold right now, you'd be losing money. But what the herd tends to do, remember there may be thousands of people in there in that position. You won't be in there alone, I can assure you. Now, what they, in their mind, traditionally, the herd will be thinking, oh, no, I don't like this. Right, if this market goes up, I'm getting out of this position. I don't like it at all. I don't like this, losing money like this. That's in their mind. Professional money know that. Now, if the professional money happen to be bullish, right, what they want to do, they don't want to have to absorb selling from those traders locked in at that last high. It's not good business. They want to buy at the lower parts. They don't want to buy at a higher level. To them, it looks like a higher level. So they know from experience, if they can gun that up and a widespread through that area, there will be a lot of traders, right? When they come home from work and switch it on, they look and say, oh, look, I'm actually making a profit, look. Where the previous day, they were potentially weak holders. So look at that and say, oh, God, look, I'm up. They're wonderful. So what do? They don't sell. But that's what the professional money want. They don't want to have to buy from these, what appears to them, higher prices. They don't want to do that. So they gun it up, and the high volume, they're prepared to absorb any people that do sell in there, sitting there and thinking, right, I'm getting out of here. They are happy to do that. Now, as Gavin said, to prove that is, in fact, what we call absorption volume, in other words, you're absorbing people locked in at the higher level to the left, right? They're prepared to absorb any of their selling. And hopefully it'll stop a lot of them selling, right? To test, you need to test. You need to see within, I don't know, so many bars is a down bar, which can be quite fairly quick with these absorption volume bars. It can be within 3 bars. And you see a down bar, and it's a test. In other words, it's gone down, right? It's a be a red bar, close in the middle probably, or even the high. And you look at the volume definitely low. That means that when they marked it down, there was no further selling. And that's all they want to know. Their absorption volume has been successful. And then they can carry on with their bullish up move. They don't care about you. They've helped you out of a bad position because they know if you got locked in at that last high, you'll probably do the same thing at a much higher level. They're not concerned about that because they go by statistics of how the herd behaves. And that's well known, the way the herd behaves in certain circumstances, certainly amongst the professional players. But that's absorption volume.
Yeah, and Thomas asked a question, do you know in advance of that absorption move that it's going to happen? No, unfortunately there's no real way of telling. All you look for, you see, because you can get this happening, price rejection. What you can do, if you want to be a breakout trader, is when the market pushes above here, is you can try to get long on one of these bars. But remember, very often there'll be reversals. There'll be what we call false breakouts. So there's nothing really, the only thing you could look for, Thomas, that would make you look to go long would be some sort of no supply bar in the uptrend. That would then mean, yes, the market's likely to push through that resistance line. This happens about 20% of the time. 80% of the time, ultra-high volume bars are weak bars, but sometimes they're tested. William was asking, is it okay to have above average volume on the Barclays bar A? And the answer was yes, that wouldn't have been a problem because there was a test there. And yeah, that's fine. And Alan says, test is testing for supply. Is no supply testing for supply? It's the same thing, Alan, really. Yeah, it's a good question. When you have no supply, it's really a test, isn't it, Tom? No supply is another word for a test. But it's very powerful, the no supply bar, when you have it and you've got strength in the background. Okay? So after the absorption has taken place, wait for a test. Okay. Principle 5. It's a variation of stopping volume which has arrived on 2 bars rather than 1 bar. On the first bar, supply was so heavy that professional money was unable to absorb all the stock or whatever it was dumped onto the market. This allows the market to fall on the next bar, usually on so-called news. This can be gapped down, okay, and it does, on the opening, causing the panic. However, to close in the middle or highs indicates demand has overcome supply. Now, this is a principle that we call bag holding, and here there's 2 things that happen with bag holding. Number one, you're going to notice that the market goes down into fresh new ground and the volume is extremely high, massive. That's the important bit. Secondly, you'll find very often after bag holding, they'll test the market immediately and it will respond extremely positively. Now, bag holding, Tom's favourite signal. Okay, and let's just talk about this. Tom, what is bag holding? One of your favourites?
Well, it's one of my favourites because it's so obvious. It's actually the reversal, more or less, of an end of a rising market. Bag holding is the end of a falling market. And what happens is, I remember, so many years ago now, probably most of you weren't even born, but I was watching the FTSE 100, and the market had fallen, right? We saw climactic action, in other words, stopping volume, right? The market was more or less churning a little bit sideways. And then the Chancellor of the Exchequer of England, because the economy was so bad, suddenly threw down and said, I'm resigning. And what happened? The market plummeted down, gapped down, but at the end of the day, it was a narrow spread and the volume was massive, right? And I think it closed in the middle somewhere. But that's bag holding. And they call it bag holding because when you get some horrific news like that, they can take advantage of. They open the bag and say, right, okay, we'll take everything. Throw it all in the bag, we'll have it. And that's what happened. And of course, the market then had a huge bull move after that. So that's bag holding. But if you ever see that, you need to jump in and go long.
Yep. Okay, so we're going to overrun a little bit here, but I hope you'll allow us to do that because we've got lots of information here for you, so we'll overrun a little bit here. But, bag holding is a great signal because it is the end of the, it's the opposite of the end of a rising market. And if it's on ultra-high volume, the narrower the spread, the better, really. The narrower the spread, the better. And if it does that, something is capping the market. Here's the problem, though. This is why you might miss it. It's because the news will be so bad, won't it? Yeah. The news will be bad, and you'll look at the chart and go, that can't be right. It's a bit like BP, although that wasn't bag holding, but that was a shakeout. But the news was so bad that we were like, well, that can't be right. They can't be buying BP, but they were. It doubled in value. So I always, Tom just goes long, don't you, on bag holding? You don't even hesitate. He doesn't even hesitate. Just takes a long position. Doesn't even bother with looking for a test. Lance, I'm afraid I can't repeat that. That's very funny. I'll tell Tom that one later. Very good. All right, so the selling climax. Widespread down bars. Okay, again, this is as powerful as bag holding. Widespread down bars closing in the middle or high after, this is the important bit, after a substantial down move has already taken place. The volume will be ultra high. As a market falls day after day, a point will be reached when traders will start to panic and, encouraged by all the bad news, will start to dump onto the market. I say stock here, but it could be anything. It doesn't have to be stock. It could be gold, it could be oil, anything. If the market closes in the middle or high, their professional money must have decided that the lower prices now look attractive. Okay, and they will start to buy into the panic selling. The activity will cause the volume to be ultra high. This point is the low of the market. This marks the bottom, and it's a bit similar to the bag holding signal, except the spread is wider. Okay, and you see these all the time. They're very, very common. So Tom, selling climax is a very powerful signal as well. Describe what's going on when that happens from a VSA point of view.
Right, a selling climax is called a selling climax because it means that there's been a lot of people that are locked into poor positions, can't stand the losses any longer, and they dump. In other words, they're selling. And the professional money will then say, thank you very much. They will absorb all of that selling, and that makes the market bullish market rather than a bearish market. And that's why it's called a selling climax. and it's like a glorified stopping volume. The spread might be wide, the news would be bad, and so on, all that stuff. But whenever you see that, but expect it to be tested somewhere along the line. But that's a selling climax. Of course, that's the opposite to a buying climax, which you see at the top. But it's called selling because the herd can't stand the lower prices any longer. And traditionally, they say, I'm out of here, I'm selling, I can't stand this. And they all tend to do it. They all tend to, the herd tends to run all together. And once they're going, very little can stop them, and they sell. And we can detect that on the chart. It'd be a down bar, massive volume, usually widespread, close in the middle usually, and the news will be horrific. The worse, the better.
A couple of questions came in. Is that similar to a shakeout? Is that really what they're doing?
Well, a shakeout, it's not really, no. A climax, selling climax, is created by herd behavior. See, when you get these bear markets and the markets are falling every day, down, every week down, and even every month, and so a point will be reached where all those traders that were locked in at higher prices, which you get in these bear markets, will tend to panic at the same time, and they will tend to dump all their holdings, usually on some bad news. But a shakeout is far more deliberate. Usually shakeout, you already have some strength in the background, and they see an opportunity of some bad news appearing, right? There may be a bit of supply around, they want to shake out, so they ram it down on this bad news. Usually, well, practically always closes on the high. The volume is very, very high, and you see that quite often. And of course, if you're long, you're going to have trouble trading that, because that's why it's there anyway. But that's a shakeout. It's not quite so dramatic as a selling climax, but it is there.
Yeah, thanks, Tom. Yeah, and you'll find usually the volume on a selling climax is enormous. I mean, shakeouts can happen on high volume and ultra high, but on a selling climax, it will be ultra high volume. It will be massive. It will stand out like Yao Ming on Yao Ming's shoulders. It will be big. So it's a serious sign of strength, okay, very serious. And then any time after that, you see a test of that, I go long. Very powerful signal. And then principle 7 here is the shakeout, okay? And the shakeout is a widespread down, closing in the middle or low, most often seen after a strong down move. Volume can be high on a shakeout, or it can be ultra high. See the difference between the shakeout and the selling climax? Selling climax, ultra high volume, has to be ultra high. Shakeouts can happen on high volume. Is that the shakeout, says Seneca, at the right of the chart? I'm not sure what you mean there. It's right there. Well, is this a shakeout up here, I think you might be asking? Yeah, that's a shakeout. Well spotted. Yeah, it is. It is a shakeout. Yeah.
You get shakeouts as the markets are very often bullish, right? But there's a bit of supply there they want to shake out.
Yeah. So Tom's saying shakeouts happen in bullish markets, and they do that all the time. And you know, that's a great example, actually, that one there. Is look, there's the shakeout there at the market. The market falls, the volume comes in, they buy it back, and up it goes. So that's well spotted, Seneca. It's exactly right. That is a shakeout. And here's another example. Point A, okay, this is Microsoft. The news was bad that day, very, very bad. The stock gaps down. It's in an uptrend already. You've got strength in the background here. It's built a cause for its up move. Look, there's your absorption volume that we just talked about. It makes a nice move up, makes another new high. Professional money come in and says, thanks very much indeed, I'll take that. And it closes in the middle there on very big volume. And then it's tested 2 bars later. And that is a very good example of a shakeout. And again, notice that the shakeouts happen on down bars. Goran, this price here is on a down bar. It's not closing higher. Now, on the shakeout that we just looked at on the previous bar, it did close on the high. Shakeouts can close on the low and the high, correct, Tom? Yeah. So let me just get Tom to explain that, because Goran, that was a good question. Explain why shakeouts can close on the low and the high.
Well, it depends on market conditions at that moment. You see, it's all very well seeing these markets marked up and down, but that can't cost them money. They can't move the market at no cost at all. So, but what they do is that if conditions are right, they know that they can, if they can shake the market out, ram it down and close on the low, right, that's wonderful, because they shake the market out, and that's a new way of getting a fresh leg up. But sometimes they close on the high as well. You just understand the principle, and you'll see it all. And but it's quite interesting to know what the news was as that happened. And inevitably, shakeout is so-called bad news. And if you know the news was potentially so-called bad, then you know that's a shakeout and expect higher prices.
Yeah, TP just said, Gavin, could you go and have a look at the Aussie dollar and tell us what your thoughts are on it? It's a mess, basically. It's a mess. It's not doing anything, is it? It's not taking out these lows, which is why I'm watching it very, very carefully. If it starts to run up into this bar, I'm just going to close the position out. It's not doing what I expect. There is some high volume here, but there's also low volume bars like here. It's not being sold at this level. So someone's trying to hold this up. If it goes, it's going to go. And that's what, I know that this is in the background. Okay, that has not disappeared. Now, if we look at the closing price of that bar, it's now they're trying to catch people out here. If this holds its line here and it refuses to go higher, then it'll fall. It'll happen quite quickly, because they'll probably use a gotcha bar maneuver. But I don't see what's holding this market up now is the volume on that bar. There's some support down there, and they've tested it here, they've tested it there. But I'm still short, and I'm going to stay short on this because I've got two principles right behind me. Can anyone? Well, look at the Yao Ming bar. It's on an up bar, right? And the next bar closed lower, and then it's gone back up to that level, and there's now very low volume on that bar. Now, we get a response to that. Market did fall. It fell down to its low here. And the low is at 212. So that's a key line for me. Because if I get down through there, I'm going to start scaling into my position. Not out of it, into it. I'm going to start adding to the position. Okay, knowing that it's going to want to come down to the round number. But you see, it might not be ready yet, TP. It may not be ready. And if that happens, I've just got to watch the behavior of the market to tell me if it's going to do that. Remember, once you're in, you just manage the trade. That's the job. You manage your position. You manage the trade through. And that's the whole thing about trading and investing. And anything you do, once you're in the market, look to the market and manage the trade. What do we notice about this bar here? Well, we notice a few observations. We're definitely making lower highs on the bar. All right, so we're definitely making downward progress since that bar. But we've also got a very clear delineated support line down here, in fact, which we're coming down to now. So again, we let the chart talk to us. Does the chart make sense? It's a language, remember. It's talking to me. It's telling me things. And it's saying, yeah, I've rejected the upper line here. I've tested it. At the moment, the test is failing. Okay. Where can we get to here? What do we want to see? We want to see an increase in volume on a down bar closing on the low through 1.0215. Okay, and Daniel says this is a very good example. Look, the one thing about doing this mentorship course with you all is we wanted to combine PowerPoint slides with live charts, and what we'll see from that and what we'll learn from that is that we don't just read the market in hindsight, we read the market in foresight. Okay, we're looking at charts and we're trading real money. I mean, I don't want you to think that I'm teaching you stuff and Tom is teaching you stuff and we're not trading real money. We're trading our live account, and we'll be trading our live account for the rest of this week. And we will trade, and if we make losses, we'll make losses. If we make money, we make money. The bottom line is we know how to trade. We don't always make winning trades, but most of the time at the end of the week, we've made more money than we've lost. And that's what trading is. Trading is all about that. Trading is about being in the market, reading the market, being relaxed about your trading, understand what the market's telling you, but know anything could happen and be ready for it. Be a professional. Be prepared. Okay, let's carry on and finish the PowerPoint. So, shakeout. It's another one on, and I need you still for a little while, so don't go and have a rest. We've got another 15 minutes, and then we're done. Yeah, the master's itching to go and get something to eat, but I'm going to keep watching this chart here. This is another shakeout. Okay, and you can see here at point A, we actually have a gap down at point A. And as the market gaps, okay, we see professional support coming in. We actually have a test on the very next bar at bar B. And then finally, we come down to the same level at point C and up we go. The question is, how many times can they test that level? It can be 5 times. It can be 1 time. It can be 3 times. There's no set rules for how many times they can test. None. Okay. Usually, in my experience, it's about 4 or 5 times usually that they'll retest a level and then they'll build a cause to go up that you can see here. And on this chart, YF says, I see 2 up thrusts on this chart. Is that an up thrust? Well, not with that right in the background. It's not. No. It looks like one, doesn't it? Absolutely looks like one. I used to think that. I said, there's an up thrust. And did the market fall? It did, but not much, because you've got strength here in the background. And YF, that's something you've got to keep in mind. You've got very, very high volume on this down bar. There's a test there. So is that up thrust in the right place? Not really. And in fact, if you were short there, you'd have been stopped out up here, because that is not in the right place, because you've got strength right there. It looks like an up thrust though, doesn't it? And this confuses some people. They say, oh, well, look, it looks like one. It's got pretty high volume. It closes on the low, but there's one there and there's one there. The market did fall a bit, but remember, it didn't fall very much because you got that right in the background. You got a shakeout. So could you trade that up thrust short and would you have made money? Yep. You'd have made a bit of money. And I personally wouldn't trade that up thrust. It's not in the right place. That would be much better in a downtrend or when there's serious resistance. But at this moment in time, that isn't what we saw. But could you trade it? If you want to, yeah. A is not a gotcha bar. No, it's not. No, it's not a gotcha bar because it closes in the middle. Michael, a gotcha bar would close on the low with the next bar down. This closes in the middle. Okay, so that's why. Look at where the gotcha bars close on the low. That is not a gotcha bar because it closes in the middle. And it's immediately tested with a positive response on the next bar. And it's a language. Look, what do we see here? We see accumulation going on. And you know, I don't buy in here. This is not where I'm interested in buying at all. I look to the top of this shakeout bar and I wait for the market to rally away from it and buy in these areas. Yes, I've missed the bottom of the market. So what? Who cares? I don't. I just want to take a piece of the action. I have not put any indicators here, William, on this chart. They're just bars. We're teaching you bar by bar analysis. And yes, it would have had a signal on it, William, yes. They probably would have had a signal on. Yep. They would have had a signal on them. But on this instance, I've actually taken the signals off. Let's go and have a quick look where we're at currently. Okay, so I'm approaching my profit target here. So let's have a quick look at where we're at with the Aussie dollar. Okay, so we're right on my profit target here, which is my initial target. Okay, so I'm just going to wait here to see where we close on this bar. Can everyone see my trading dome, by the way? Don't know if anyone, can you all see that? Because I'm broadcasting the dome right now, just so you can see where we're at. And I'm at my profit target for my initial target. And rather than scale in here, I think what I'm going to do is watch to see where the market goes on this bar, because they could support this level. Yeah, they're testing this low. Okay, so yeah, no, Lance, let me be very, very clear with you. This is not a demo account. This is a real account. This is real money. Okay, this is not a demonstration account, but good try. Now, if you see us trade, Tom and I, we trade our live accounts. We're not trading on a simulator. Please be aware of that. I want you to all know that we're teaching you, and what we teach you, we trade. Okay, we're real traders. We're not pretend traders. You know, I get really annoyed with the snake oil salesmen out there that do that. They pretend they're trading and they're not trading at all. Okay, so what I'm going to do here is now put the chart up and show you what I see, and why I'm going to let that trade run a little. And then we'll just finish off on this last principle, and then Tom can go and have a rest. Not just yet, though. You getting tired?
No, I'm just going to turn the heating off.
Okay, he's going to turn the heating off. Okay. Yeah, so anyway, I'm short the Aussie here, Tom, and just so you know, we've had a mini gotcha bar. We were looking for it to come down to this area. If this next bar closes lower, then we will have a Red Bull, says Lance. have a Red Bull. Fiona says, that's why we like you. You're an honest, pommy bloke. They like us because we're honest, pommy blokes. Okay. Honest, pommy blokes. All right. I'll take that as a compliment. Thank you, Fiona. An honest, pommy bloke. So, yeah, so we're trending down, aren't we? And the reason we're trending down is the Yao Ming bar. That's in control of the market at the moment, yeah? And we've got a nice round number below us, haven't we? Yeah, 1.0200. We're being drawn to the round number. There's the weakness. There's the no demand. And look at how the trend channel is holding. We've now broken the support line. And now what I'd be looking for is another gotcha bar down to the 1.0200. That'll give me my $400 profit target, and this is a $5,000 account. I made $400 yesterday, another $400 today. You can see how the account builds up. Okay, let's finish off on one more shakeout. This is one of my favorites, and then we're going to wrap up for the day. But yeah, it was a nice shakeout here. Look at that. This was news that did this. This was a news-driven event. We had some news about Microsoft and the market gap down. But three things happened on this chart which were incredible. We had an up bar on the very next bar. And then a few bars later, an immediate test. Look at that. Doesn't get any better than that. And it was at the bottom of the upper trend line, which then acted as support. Yeah. Can you use a trailing stop? Oh yes, I will do. Yeah. A YF, you can rest assured, I'll be trailing my stop down with this trade. Absolutely. Yeah. Absolutely. But yeah, so we see the shakeout here, don't we? We see the shakeout. Widespread down. Next bar closes higher. Demand is overcoming supply. What was the news? There it was on the same day. US stock, Wall Street sinks on weak retail sales, Goldman offering. But the financial sector, which had recently led the stock market's 5-week rebound from 12-year lows, took the biggest beating by far. Yeah, it did. And then it rallied. But they never tell you that. They never tell you that. And it rallied massively. So, when you see a shakeout and you want to go long, you're better off waiting for the test. Because the shakeout happens, that's your Yao Ming bar, as we call it. And now you look for the test of that shakeout bar, and that's where you go long. If you'd been long, you'd have been washed out. Oh yeah, that's the reason they have shakeouts, is to wash you out the market. But that's where you should go straight back in. That's the bit I had to learn from Tom. You know, I'd get washed out of a trade and I'm really angry, and suddenly I realized I should have been buying. And suddenly there's no more anger, there's no more fear, because I know how the market works. Sometimes you do get shaken out. It's called a shakeout because it does what it says on the tin. Yeah, no, my trade's working very nicely. Yeah, no, it's now down at 209, and now you've got the increase in volume on a down bar. I want to watch where this closes, but no, I think I'll probably take some profit fairly shortly on this. Let's see where we're currently at. And now I'm at my target, my secondary target. Yep, no, that's fine. That's fine. Yeah, so we'll see what happens, see where this closes. But now this is pushing down nicely. And that bar there is in control. And until you see an opposing principle, there would be no reason there to close a position out at the moment, because everything's doing as I now expect. I was not looking to buy in here because that bar, which we didn't see when this was happening, suddenly appeared. And there is a setup live. You've just seen it live. Now I've got some strength coming in here, so I'm going to take some profit here because we do have a bit of strength coming in on the bar. And let me just let it run. Yeah, it's going back down to the 1.200 number. Okay, so there's a little bit of support coming in here. So I'm going to actually flatten this and take some profit. Okay, let me just show you all my screen here, and just so you can see, so far in the session there, I netted $260 on a small account. But now I'm going to wait because I think I can get back in up here, up at the top. I'll show you that in a second. So I've netted some profit there on the trade. Now, what I look for is another opportunity. Okay, so now I'm looking for the next opportunity, because what they'll probably do, doesn't always happen, is mark this back up to the top of my trend channel and I can get in. Yeah, I decided not to scale in here actually, and the reason is I think now they're going to pop it up for one more look at this level. Happens a lot, and I'd rather lock in some profit rather than add to that position. I decided to take profit. That's purely because I'm at a level now where I've seen high volume and a down bar. If that closes up, this will pop up, and I would be giving money back to the market, which I don't like to do. I had to take little and often, and it all adds up once you do that, as you'll learn. So my favorite signal finally, and then we'll wrap it up, the test in a rising market. Okay, the test in a rising market. This is a very, very powerful indicator, because it happens after some sort of shakeout that's taken place. Now what happens is you see ultra high volume coming in, and then you get what we call lack of selling pressure as the market falls to this level. Here we see there's no selling pressure on the bar, and then finally we retrace and we test here and here as the market's beginning to rally. So tests in a rising market are very, very common, and they're very common in the last year. On the daily charts, we've seen numerous ones. Here was the actual trade that I took at the New York Traders Expo. Okay, so we had a shakeout in the background there that you can't see, and then we had here a test, and then here and here we had tests in a rising market. Now I took the trade in the New York Traders Expo competition on that bar and got out on the no demand bar. So I actually was only in the market 20 minutes there, and I made about $300 on that trade. Now that was in front of a live audience, and I can assure you that if you want to learn to trade, do it in front of a large group. You pretty much realise what the gladiators felt like when they were going into the lion's den. It can be quite frightening, but the principle was there, wasn't it? In the background here was your shakeout. They tested the shakeout. They moved above the shakeout bar, and that was the test of the top of the shakeout bar, and was in fact a test in a rising market. And in fact, that was a great setup. And you see those a lot. Here's your no supply bar, which again is similar to a test. No supply is similar to a test. And again, there's the signal. A test in a rising market, but what makes it a powerful signal is the fact that it's in a rising market at that time, that it's going up, and that you've got strength in the background. You've got strength right behind you. You've got the shakeout right behind you. Here's another example in the E-mini S&P. The market's marked down, ultra high volume. It goes down to the top of the bar, tests it, and both of these signals come in. They're both tests in a rising market. Here it is. And you can see, and you're going to get a copy of this PowerPoint slide where it actually says 2 contracts, Lance. So I just traded 2 lots. my risk on that trade was then, as I moved the stop down, was $50, and we made $260. So I should get back in. I should get back in. You know, there's opportunities there, definitely. So, a test in a rising market. How do you trade it? Well, it's very similar to no supply. It means the same thing. When you see no supply with climactic action or buying in the background, higher prices are almost inevitable, and they always are, and you want to get long when you see them, because that means the market is becoming bullish, and the test will always be very much on a down bar, but you do see tests on bars that close higher than the bar behind them. You do see that. And then trigger numbers. These are areas where we actually see the market from yesterday move forward, and the market comes back down to the levels and respects them. Now, here is the closing of the NASDAQ 15-minute chart. And I noticed that on the very high Yao Ming bars, I mark the tops of the bars, and here, and on these overnight highs, and I watch where the market goes as it gets to these levels. Okay, I watch where it goes. And what I see here is at certain levels, the market is respected. Now, there is a shakeout at yesterday's ultra-high volume level. You see that all the time, where it's marked down like that to yesterday's highs, and I call these trigger numbers. Okay, now triggers are where, if the market comes down to those levels, I'm paying a big attention, if you like, to what the volume is telling me at those levels. And if the volume is high or ultra high, and then the market reacts positively, which it does in this case, I look for the test. And that, in fact, moved that NASDAQ chart up very, very rapidly. So, some things to remember before you go long. Look at the trend. Are you in an uptrend, or is the market still downtrending? Is the market rising on no demand? Because if it is, it means it's probably going to fall further. Is the high of each bar higher than the previous bar? Remember Tom's trending system. Are you at a fresh low ground when accumulation starts? Is there a trading range to the left? Is there lots of bad news? And someone asked earlier, do professional money move the market on news? Yes, they absolutely do. They take every opportunity to move the money, to move the market on news. Remember, is the market in an oversold or overbought area of the trend channel? Is there a buying climax in the background? If you've got, if you're going long and you've got a buying climax or the end of a rising market in the background, you're in trouble. Are you entering on an up bar? Remember, strength appears on down bars. So in summary of this first 2 days, let's look at some of the things that make us important here. And it looks like the Aussie dollar is coming down to the 1.02. Now, what we should see is a bit of a mini rally back up to 1.210 on no demand, and that will give us potentially another entry. So each of us are unique. We have different account sizes, different loss tolerance levels, different experience levels, different ways of viewing things. Two people can look at the same mountain from the same place and see entirely different perspectives. And also, we all have different levels of self-discipline. The strategies of VSA are a guide. They must be adapted to your style of trading and personality, and I'm afraid only you can do that for yourself. The VSA principles apply to all markets where there is volume available and in all time frames. We've been looking today at stocks and Forex. We looked at a number, but it works in all markets: futures, commodities, spot Forex, the lot. KISS, keep it simple. Nothing here is rocket science. VSA is a very logical system based on principles that have been around for decades. Take a holistic approach to reading your charts. Remember, look at the whole and the interdependence of its parts. The market has now hit 1.0200 on the Aussie, which is great. It's continued to go down, which is great. So they're marking it down even further. And now we'll very likely see this market potentially go back up to that 1.200, and it's come off nicely, Tom. I took some profit off there already. I was going to actually add to the position, but I actually took some profit. But we should get another trade on this later on. Now remember, strength appears on down bars. Weakness appears on up bars. The background is vital to your analysis. Has the strength or weakness appeared at the top or bottom of a trend channel? Is this a major trend reversal or a retracement? Ask yourself, if you're trading stocks especially, is the news good or bad? If it's good and it's going up on ultra high volume, you probably want to short it. If it's bad and it's going down and there's ultra high volume and the signal's there, you probably want to buy it. Is demand overcoming supply? Or is it the opposite, selling overcoming demand or buying overcoming supply? That's how the markets work. Remember, all the patterns we teach you have been seen in the past. They'll be there in the future, as we saw today. We traded an Australian dollar chart to the short side. VSA is a discretionary methodology that still requires discipline and money management. VSA is much more effective when used with support and resistance lines, and also we use something called the Weiss wave, not Elliott wave, although some of our customers do use that. We use something called Weiss wave, and I'll get David to come in at some point this week and show you what that is. You must use more than one time frame. Notice today we used a 5-minute and a 15-minute chart to see what the market was doing. If you listen to the news, be contrarian. Okay, always think the opposite of the herd. The chart never lies. Rely on your charting skills. Okay, a few final words from the master, and then we're going to wrap it up. We have overrun. I apologise for that. We're 35 minutes over, but obviously we enjoy doing this, as you can tell. I hope you all enjoyed that. I hope you learned something, and we had a nice little trade there to the short side, Tom, on the Aussie. So it didn't behave like a strong market should behave, did it? And I was right on that one. I nailed that one a bit. But anyway, here's Tom to give you a few final words, and we'll be back with you tomorrow, same time, same place, same link. Here's Tom for a few final words.
Right, Gav, thanks for that. Okay, look forward to seeing you all tomorrow. We start off at midday here in the UK, and Gavin, as usual, will be, I call him the ringmaster, you know, standing there with his whip, sort of controlling everything, which he loves to do and which he's good at, I must admit. Yes, we look at the Aussie dollar. There was some strength came in, but bang, there's obviously a serious sign of weakness there. In hindsight, it's pretty obvious. It's an upthrust followed by no demand.
It's the supply coming in. It wasn't an upthrust, it was just supply.
Supply coming in.
Yeah, followed by no demand.
Followed by no demand. Right, which had a signal on it too. So it's all, you won't be wasting your time, because this knowledge, whatever you know now, you'll know more next year, that's for sure, and you'll be very excited to be able to read these charts, because it is a language like Braille talking to you there, and you will know more about the market than most people on the face of this earth, and you will have that knowledge with you for the rest of your life. And of course, the more you study, the more you look at it, the better you'll become, just like everything else. I love looking at the charts. I find it fascinating. You don't have to be actively trading all the time, but, you know, we're all individuals. We all have our own different points of view. Gavin trades differently to I do, but it doesn't mean to say I'm right and he's wrong or anything like that. It's your individual behavior as a human being. But I'll say thank you very, very much for listening to us, and I hope you've picked something up, and we'll see you tomorrow.
Yeah, thanks everybody. Best wishes, good trading, wish you constant profits, and hope you learned something today. That indeed was no demand after weakness, and yes, in hindsight, I could have taken an extra 10 ticks out that trade, but I'm always grateful for the money that I make in the market, and I always know that tomorrow's another day, and that there'll be more money to be made. And I think like a winner, I act like a winner, and I want you to think the same way. You can read these charts, you can be successful with a little bit of effort, a little bit of practice. And by the way, thanks for all the great questions today. Very, very good questions, and a great way to end the seminar as well, with some money on the board. Take care, everyone. God bless everyone. Have a great rest of your day, and I'll see you tomorrow, same time. Bye-bye, everyone.